Hello and welcome to Session 18 of the Basic Tax course. We're going to begin Session 18 with a review of the Session 16 quiz answer key. I have up in front of you now the Session 16 quiz, and I'm going to review the most frequently missed questions. Beginning with the very first question, question number 1. You must elect to use the installment method for reporting income from an installment sale by the due date of the return for the year of sale. That is a false statement, and the reason it is false is, well, it's exactly the opposite of the truth. The truth is that the installment method is automatic, and if you do not wish to use the installment method, you must elect out of the installment method on a timely filed return. Number 2, the installment method is not used if a loss is calculated on the disposition of property, even if payments are made in installments. That is true. The installment method is used to allow a person to report income from an installment sale over time as they receive payments. But if they have a loss, there's no reason to even think you could have an installment sale because you would just be postponing the loss. In any event, you do not delay a loss through an installment method, but you can postpone the reporting of gains under the installment method. Number 4, which of the following cannot be reported using the installment method? And it gives you a choice of capital gain, unrecaptured Section 1250 gain, recaptured Section 1245 gain, or all of the above. And this is something I thought I was hammering into people throughout this course, and that is that Section 1250 gain is something that does get special treatment, including under the installment method. So Section 1250 gain is taxed at a lower rate. It's given capital gain rates. And of course, the installment method is used to allow a person or a business to spread reporting of income from capital gain on the sale of assets over time. And Section 1250 gain is reported as a kind of capital gain, and therefore the installment method applies to it. But Section 1245 gain is not eligible for capital gain treatment. It is reported as ordinary income, and in addition to that, in the year of sale, you have to report the entire recapture of Section 1245 gain in the year of sale, regardless of the amount of payments you actually received under the installment method. Number 5, if married taxpayers file a joint return for the year they sold their home, they can exclude $250,000 of gain if either spouse individually meets the ownership and use tests, and $500,000 if they both meet the use test and at least one of them meets the ownership test. Well, that's true. There's not a requirement that both spouses be owners of the house, only that both spouses occupy the house. And as long as one of them owns the house for 2 out of the last 5 years and both occupy the house for 2 out of the last 5 years, they can exclude full $500,000. Number 8, John and Betty Ford were married in September 2008. They each decided to sell their homes and purchase a new home together. Both John and Betty meet the ownership and residency tests for their respective homes. John sold his home at a gain of $325,000, and Betty sold her home at a gain of $150,000. What amount of gain can they exclude from their income on their joint return for 2010? Well, this example or this question is very different from the preceding question, because in the preceding question, one person owned the home, but both lived in it. In this illustration, there's 2 separate homes, and on each of those homes, only one spouse lived in the home. And since only one spouse lived in the home, then that spouse will be able to exclude up to $250,000 of gain, but not more. And so we have a situation where we're allowed to exclude $250,000 for John, $150,000 for Betty, and the combined total is $400,000. Number 9. Jerry purchased a rental home in 1996. He moved into and lived in the home from April 15, 2005 to September 1, 2009. He then rented the home again until he sold it. Jerry has not claimed the sale of home exclusion in the past 2 years, and which of the following statements is true? A, Jerry cannot claim the exclusion for gain on the sale of his rental property. Well, there's no gain on the sale of a rental property because this is a sale of a home because he met the ownership and use test 2 out of the last 5 years. Now, there is a rule that any rental use that comes after 2008 and before personal use begins again, is not eligible for this exclusion, but that is not the case in this problem. All of the rental use was before 2008, so we're fine there, or before 2009, so we're fine there. B, Jerry claimed the exclusion for gain on the sale of the property, but he must report or recapture all depreciation claims since 1996. Well, since 1996 is simply the wrong date. You're kind of hinting at the right information there, but the correct date is actually May 7, 1997. So where it says Jerry can claim the exclusion for gain on the sale of the property, but he must recapture all depreciation claims since May 7, 1997. That is the true statement. And the last question we're going to review is the mini problem. Dora Explorer sold her vacation home to SpongeBob. She has the following information to report for the sale. She bought it on January 31, 2009 for $200,000, and she sold it on May 31, 2010 for $400,000. So that's a nice gain for a short period of time. During the period of ownership, she put $18,000 of improvements into the property, and therefore we're going to give her a cost basis in that property of $218,000, and that $218,000 is going to carry over to the form 6252 for installment sales and is entered on line 8. She had expenses on the sale, including required repairs within 6 months of sale, commissions of $25,000, closing costs of $2,500. She will add all of those up, and that gives her $30,000 that will carry to line 11 of Form 6252. Next, we look at the payments that she received during the year, and we made it pretty simple here. We didn't even ask you to kind of add things up on an amortization schedule. We simply told you how much she had received in payments. Those payments are shown right here, $50,000 down, $2,500 in total monthly payment by the end of the year. So that gives her $52,500 of payments received during the year, and those are reported on Form 6252 on line 21. Finally, we have interest that she received on the sale during the year, and that needs to be reported on Schedule B on line 1. So let's take a look at this finished return for Dora Explorer. And here is Dora's finished 6252, showing all of the entries that I just explained to you. Here we have, on line 5, we've entered the gross sales price of $400,000. On line 8, we've entered the cost basis of the property. On line 11, we've entered the expenses of the sale. And we take expenses of the sale and add those to the cost basis in the property to get the amount that we will then enter on line 13. Line 13 is subtracted from line 5 to give us our net gain on the sale, and that's $152,000 of gain. Next, we take $152,000, divide that by $400,000, and we get our gross profit percentage of 38%. We then enter the amount of payments received during the year of $52,000, and we divide or multiply $52,500 by 38%. That gives us installment sale income for the year of $19,950. And of course, this is the amount that would carry to Form 1040 and be entered on line 13 as capital gain income. Dora also needs to file a Schedule B with her return, and on this Schedule B we show that she received payments from SpongeBob. The amount she received was $8,000, and of course we do show SpongeBob's Social Security number and address as is required. So that concludes the review of the Session 16 Quiz Answer Key. We're going to move on now to a review of the Session 17 homework assignment. It involves preparation of a more complex tax return involving rental income and expenses for Mickey and Minnie Mouse. And because they needed to have some extra cash, they decided to rent out one of the bedrooms in their home to a tenant named Goofy. And Goofy has the exclusive use of one bedroom, one bathroom, and then shares the living room and kitchen with the Mouses. And then, of course, the Mouses have some area that is exclusive use to them. Mickey has calculated that his home is 30% tenant use and 70% business use, and he had the following expenses for the year: mortgage interest of $10,500, property taxes of $3,000, hazard insurance of $600, and advertising costs of $100. He also had expenses for utilities, cleaning and maintenance after the home started to be rented, repairs to Goofy's bathroom, a new roof, a new range, but those occurred in earlier years before the house was being used for rental purposes, and then he also had some rental miles that he put on the property. The Mouses purchased their home back in 1999 for $90,000, and the land value in 1999 was $30,000. The current fair market value of their home is $170,000 with a land value of $50,000. But of course, we will go for the lower of those two amounts, and that means that the cost basis for depreciation is going to be $90,000 minus the land value of $30,000, giving us $60,000. But then to that, we are going to add the cost of the new roof and the cost of the new range to pull up the cost basis of the property to include those amounts. Goofy paid a refundable security deposit of $800, and because it's refundable, it does not get included in income. But he also paid the last month's rent of $500 and the first month's rent of $500, and then began paying $500 a month for April through December. But essentially, we've got 11 months of rent received during the year, and 11 times 500 is $5,500. Now, this may seem to be a weird way to write the description for this problem, but the reason I do it this way is because that's how clients think. When you ask a client how much rent they got, they don't typically bring in a P&L showing their rental income and expenses for the year. They'll just sit here and go, well, let me see, I got January, February, March, but then I didn't have a tenant for 2 months, so then I got the rest of the year. That's how clients talk to you when you're preparing their tax returns. So I create a tax problem that gives you an illustration of how tax clients actually think and work with their tax preparers. The Mouses made cash contributions of $1,000 to the Nature Conservancy and $500 to Food Aid, so that obviously is a Schedule A charitable deduction. Mickey is a passive at-risk partner in Pluto, Inc. Her K-1 is attached. And because she is passive, she will be limited on her losses to the amount of any other passive income she has for the year. But she is at risk, so if she does have a loss, she will be allowed to claim it up to the amount of other passive activity income that she has. Mickey has a W-2 attached. Let's take a look at it. His wage income is $51,000. He had $5,600 of federal withholding, and he had $4,500 of state withholding. Here's the K-1. It shows a $3,600 loss, but unless the Mouses have other passive income, they're not going to be able to claim any of that loss, and we're going to have to do their Schedule E for their rental property to figure out if they have a net profit off that rental property before we'll know. So let's take a look at their answer key. So in reviewing the various expense items that the Mouses had, I created an expense worksheet just to allocate expenses, because there's a lot going on here when you have a house that's being part personal, part rental, figuring out what you can deduct and how much and where to put it and so forth. So I created this table right here to allocate expenses. And the first expense we have is the mortgage interest. And how are we going to figure out how much mortgage interest we are allowed to deduct on Schedule E and how much needs to be entered on Schedule A? Well, since the house was 30% tenant use for 10 months of the year, we need to prorate the percentage tenant use for the property as follows. We take the interest, taxes, insurance, and utilities and take 10 over 12 for the number of months it was rented, and then multiply that ratio by the percentage of the home that was occupied by the tenant, which was 30%. When we take 10 over 12 and multiply that by 30, we get 25%. So what that means is that 25% of the interest, taxes, insurance, and utility bills are going to be deductible on Schedule E, and the remaining amounts are deductible on Schedule A or not deductible at all. And of course, interest and taxes are deductible, but insurance and utilities are not. So we essentially have 75% of the cost of insurance and utilities for the year not being deductible at all, and 75% of the amount for taxes and interest being deductible on Schedule A. Now, the advertising was a direct expense related solely to the tenant, so it's allowed in full. And the cleaning and the maintenance, well, the Mouses only even started to track that after they started renting their house out to Goofy. It's 30% tenant use, so we gave 30% of that amount as deductible to the Mouses on Schedule E. So this table again breaks all those amounts out. We have the ratio on each type of expense, with the mortgage interest being 75% Schedule A, 25% Schedule E. Property taxes 75% Schedule A, 25% Schedule E. Hazard insurance is not deductible at all on Schedule A, but 25% will be allowed on Schedule E. Advertising is 100% allowed on the Schedule E. Cleaning is 70% not deductible at all, but 30% of that cost is deductible on Schedule E. The utilities, 75% not deductible, 25% is deductible on Schedule E, and the repairs to Goofy's bedroom are 100% deductible on Schedule E. So we took those amounts and factored those out. The total cost here for mortgage interest is $10,500. We're allocating $78.75 to the Schedule A and $26.25 to the Schedule E. The property taxes were $3,000. $750 is going to the rental property, $22.50 to the Schedule A. $600 for hazard insurance, $150 is going to the Schedule E, and of course $450 is not deductible. On the advertising costs, $100 was spent, $100 is allowed on Schedule E. On the cleaning after March 1st, $500 was spent, $150 is allowed on Schedule E, $350 is not deducted anywhere else. And on the utilities, we have $2,000 of total expense, with $500 being allowed for on Schedule E and the remaining $1,500 not being deductible. And finally, the repairs to Goofy's bedroom are allowed in full. All $550 is being allowed on Schedule E. Now, we also had some depreciation aspects to account for, and it is accepted procedure not to separate the cost of an individual asset within a home from all other assets placed in service on the date that that home is converted to rental use. The house is depreciated under makers using the mid-month convention over 27.5 years. If the Mouses make any other improvements to the home in future years, those improvements will be shown as separate items on the depreciation schedule. The combined depreciable basis of the home is shown next, and we already explained that the purchase price of the home was $90,000. We subtract out the land value of $30,000 to get a depreciable basis of $60,000, but then we add in the cost of the new roof in that new range to get a total basis for depreciation of $62,600. Also, the Mouses are claiming auto expenses on Schedule E, so Mickey is required to complete Part 5, Section B of Form 4562. And since their car is listed property used 50% or less in his business, they must also complete Line 27 to provide information on the use of their listed property. And of course, we have to answer all the automobile questions. And here is Mickey and Minnie's Form 1040. We show $51,000 of wage income on Line 7. And we show adjusted gross income of $51,000 as well. Line 17 is no entry on it. We'll see why that's the case. They have $16,125 of itemized deductions, so we'll need to take a look at their Schedule A to see where that comes from. And here is the Schedule A. On the Schedule A, we've entered income taxes from the W-2 of $4,500. We've also entered real estate taxes of $2,250. Giving us total tax deductions of $6,750. The home mortgage interest and points totaled $78.75 after the proration to the Schedule E. This is the amount that's left for Schedule A. And we have $1,500 of cash charity as well. So that gave the Mouses $16,125 of itemized deductions to carry to the 1040. Here is Mickey and Minnie's Schedule E. We show $5,500 of rent income. Advertising was $100. Auto expense was $100 as well, and that was essentially 200 business miles times 50 cents per mile. Cleaning and maintenance was $150. Insurance was $150. Prorated mortgage interest was $26.25. Repairs to the home were $550, particularly Goofy's room. Taxes prorated are $750, and then we had utilities prorated at $500. That gave us total expenses on line 19 of $4,925, but we have a depreciation calculation going on here as well, so let's go take a look at the depreciation. Here is Form 4562 for the Mouses. We have on line G the date that the property was placed in service, which was March of 2010. We have a basis for depreciation, and this is a rather odd number. Where did that come from? Well, we have to multiply the percentage of tenant use by the cost basis of the home. And since the home is 30% business use, we take that adjusted basis in the home and multiply that by 30%. That gives us $18,780. We're going to take $18,780, divide that by 27.5, divide that by 12, multiply that by 9.5 months, and that gives us $541. Here on line 27 of the 4562, we've entered the date that the car was placed in service and a description of the vehicle. Then on line 30, we've entered the number of business miles, the number of commute miles, all other personal miles driven, and total miles for the year. So $541 of depreciation needs to be entered on the Schedule E. And that $541 is entered right here on line 20. We add that to the other expenses on line 19, and total expenses on line 21 is $5,466. Income was $5,500. That gives an income of $34. Now it's time to prepare page 2 of Schedule E, and on page 2 we're going to report income or loss from Schedule K1. And in this case, there is a Schedule K1 from Pluto, Inc. It is an S corporation, but our loss cannot exceed our income from passive activities. And since there's a $34 profit on the rental property, we're going to be allowed to claim $34 of passive loss in column F. This $34 loss is going to offset the $34 profit from the rental property, which is the reason that the line amount on line 17 of the 1040 that I just showed you is blank. No loss is allowed. We also have, obviously, a remaining unallowed loss that's going to carry forward to 2011, so we need to complete a form for that. And the form we complete is Form 8582. On Form 8582, we show the loss that's going to be allowed for the year, the total loss that occurred for the year, and the difference between $3,600 and $34 is the carry forward to 2011. The Mouses are also eligible for a Making Work Pay credit in the amount of $800. And returning to their 1040 form, we have itemized deductions of $16,125. A personal exemption deduction for both the Mouses is totaling $7,300. That gives us taxable income of $27,575. The tax tables tell us that the tax on that is $3,299. The Mouses had $5,600 of federal withholding. They also have a Making Work Pay credit of $800. That gives them total payments of $6,400 and a refund of $3,101. So that concludes the review of the Session 17 homework assignment. At this point, please push pause on video playback, go to the LMS, and take the Session 17 quiz. When you are finished taking the Session 17 quiz, please resume video playback for the Session 18 lecture. And today's lecture is going to cover self-employment income and expenses that are figured on Schedule C, as well as office use of home figured on Form 8829. And let's get going with the Session 18 lecture. Today's lecture is going to cover self-employment income and expenses, including small business income and expenses, the domestic activities, production deduction, farm income, self-employment tax, payroll tax, and an added bonus, which is about record keeping and how to give your client good advice on record keeping. The reading assignment for today's session is very lengthy, probably too much for the average student to be fitting in the length of time that we normally allow for a session, but the IRS has stated that it will be testing on the content of publication 334, so we do recommend that you read that publication cover to cover. It's a thick publication, but the typeset is large too. But it's a worthwhile publication to read. And if you live in farming country and you deal a lot with farmers, I would strongly recommend that you also look at Publication 225, Farmer's Tax Guide. And an overview. Self-employment income is perhaps the most complex type of income that you will need to report on your personal income tax return. If you have self-employment income, you will probably need to report income and expenses on several different forms, including Schedule C, profit or loss from business, Schedule F, profit or loss from farming, Schedule SE, self-employment tax, Form 3800, general business credit, Form 4562, depreciation and amortization, Form 4684, casualties or thefts, Form 4797, sale of business property, Form 1040-ES, estimated tax for individuals, Form 8829, business use of your home, Form 8826, disabled access credit, Form 8594, asset acquisition statement, Form 8824, like-kind exchanges, Form 8846, credit for certain employer Social Security and Medicare taxes on tips. Form 8903, for the domestic production activities deduction. Form 8941, credit for small employer health insurance premiums. Form 941, Employer's Quarterly Federal Tax Return. Form 940, Employer's Annual Federal Unemployment or FUTA Tax Return. Form W-3, Transmittal of Wage and Tax Statements. Form W-2, Wage and Tax Statement. Form 1096, Annual Summary and Transmittal of U.S. Information Returns. And Form 1099, Miscellaneous Income. Now, this is just a listing of some of the relatively common tax forms that may need to be prepared in association with self-employment income. Schedule C, as we will see today, is not terribly complex in and of itself. It's just that Schedule C usually means you're going to have a lot of other tax forms that you are also preparing as a part of completing your client's tax return. And this is just a listing of some of them. There are a lot of others as well, including, of course, some of the forms that we've already looked at earlier in this course that are obviously on the list, like 4562 for depreciation and amortization. So in any event, what I'm getting at here is that self-employment is far more than just Schedule C. We're going to be taking a detailed look at Schedule C today, but there's far more that goes on with the reporting of self-employment than just the Schedule C that we're looking at. So I want you to kind of keep a broad scope or a big mind when you're thinking about Schedule C and how all of these other tax forms that we've been learning about throughout our course may interrelate with it. And here we are now on to Schedule C, Profit or Loss from Business, beginning with filing requirements. You will need to file Schedule C to report income and expenses from self-employment if either of the following is true. Your net earnings from self-employment are $400 or more, or you have received a 1099 miscellaneous reporting income of $400 or more in Box 3 Other Income, Box 5 Fishing Boat Proceeds, or Box 7 Non-Employee Compensation. Form 1099 Miscellaneous is the first aspect of self-employment that we're going to look at today. Depending on which type of income is reported, you will need to report 1099 Miscellaneous Income as rental income, royalty income, self-employment income, or you might report it on Form 1040, line 21, as other income. But never report 1099 Miscellaneous Income as line 7 wage income. That is income that you report on line 7 of Form 1040. Unless you can show that that 1099 miscellaneous was in fact issued in error and a W-2 should have been issued instead, and all of the following is true. Number 1, you can show that you were acting as an employee of your employer and not as an independent contractor or self-employed person. You have requested a W-2 from your employer and your employer has refused to issue you one. You file Form 4852 Substitute W-2 with your tax return. You must also attach Form 8919 Uncollected Social Security and Medicare Tax on Wages. And here, of course, is the Form 1099 Miscellaneous. It's got a variety of boxes in it. And we're going to take a brief look at the line instructions or the box instructions that IRS provides for each of these boxes and what you are supposed to do with the information when it appears in a box. Beginning with Box 1, Rents and Royalties. Actually, Boxes 1 and 2, Rents and Royalties. If you received real estate rental income, you may receive Form 1099 Miscellaneous with Box 1 income. Normally, you would report rents from real estate on Schedule E. However, if you provide significant services to your tenant, sold real estate as a business, or rented personal property as a business, or you and your spouse elected to be treated as a qualified joint venture, report this income on Schedule C or CEZ. Box 3, Other Income. Generally, you report other income on line 21 of Form 1040 and identify the payment. Form 1099 Miscellaneous Box 3, Other Income, is most commonly used to report prize winnings and other miscellaneous forms of income. However, if you received payment in the course of your trade or business, you should report other income on Schedule C, CEZ, or F of Form 1040. Box 4, Federal Income Tax Withheld. This box is used to show backup withholding or withholdings on gaming profits. Generally, a payer must backup withhold at a 28% rate if you did not furnish your Social Security number to the payer. Report this amount on your income tax return as withheld. Normally, Box 4 is empty, and an example of a situation where an amount might appear in Box 4 occurs with some sole proprietorships who run retail businesses and receive payment from product manufacturers or distributors in exchange for point-of-sale or advertising space in their stores. Now, we're about to see an increase, I think, in the amount of reporting that's going to be going on in Box 4. The IRS has started a new procedure where it is verifying or matching the name of a business or an individual against the identification number that appears on the 1099 miscellaneous. If there's a mismatch between the name and the number on the 1099 miscellaneous, the IRS notifies the payor who issued the 1099 miscellaneous that there is an error, and that payor has to contact the recipient or the vendor to get correct information. If it turns out that the vendor will not give correct information, or for example, the vendor just provided an invalid name or number, the payor, the business owner, has to start doing backup withholding. And backup withholding is done at a rate of 28%. So although this has been a relatively uncommon box to see a number in, I think we're about to start seeing a big change. And as I sit here in my office teaching this class today at the end of October in 2011, I can tell you that in this 1 week alone, I've had 2 separate clients of mine call me to say, hey, I've gotten a letter from the IRS telling me that there's a mismatch between a Social Security number and a name that I entered on a 1099 miscellaneous that I issued to a contractor that worked for me. And the IRS has ordered me to get correct information or begin backup withholding. And so since I've had 2 in 1 week, I expect we're going to see a big change there. So this reference here, normally Box 4 is empty. I think we're about to see a change in things. Box 5, fishing boat proceeds. An amount in this box means that the fishing boat operator considers you to be self-employed. Report this amount on Schedule C or CEZ, and you should refer to Publication 595 for Capital Construction Fund for Commercial Fishermen information. Box 6, medical and healthcare payments. You report these also, oddly enough, on Schedule C or CEZ. Sometimes people semi-volunteer to be part of a medical research group that a drug company or a hospital might be conducting, and they are often paid for being the guinea pig, and apparently IRS says that's self-employment and needs to go on Schedule C. Box 7, non-employee compensation. This box is the most commonly used box. If you have Box 7 income, you are considered to have self-employment income. If you have self-employment expenses, you must file Schedule C, CEZ, or F for Form 1040 to claim these expenses, or the IRS will tax you on the full amount that's in the box. If you receive Form 1099 miscellaneous and you do not consider yourself to be self-employed or an independent contractor, then you should request your employer to issue a Form W-2 instead. If your employer refuses to issue a Form W-2 to you, you should consult with the IRS or a tax specialist for advice on how to report your income. Well, we've talked about this previously in our course. The IRS actually does have a Form 8919 on which an employee can pay their half of Social Security and Medicare tax, but Form 8819 can only be filed when Form SS8 has also been filed, and Form SS8 is a challenge basically being filed with the IRS by a worker saying, hey, I'm an employee, my employer is not treating me as an employee, I want you to come in and do an investigation. So really what happens is when you get this 1099 miscellaneous, that is your client comes in with one, and you establish through interviewing your client that, hey, they shouldn't have gotten a 1099 miscellaneous, well, your options are somewhat limited. One of the options available is that employee could go back to the employer and request or even demand a W-2 be issued instead. But I've really yet to find a worker who's willing to confront an employer that way, and at the same time I also have yet to find a tax client who's willing to indirectly challenge their employer through filing a Form SS8. So typically what happens when I see an amount in Box 7 is non-employee compensation, we're essentially left with preparing a Schedule C and forcing that individual to pay self-employment tax. Box 8, substitute payments in lieu of dividends or interest. Substitute payment means a payment in lieu of a dividend or tax-exempt interest to the extent that interest, including original issue discount, has accrued while these securities were on loan. You should report this amount on the other income line of Form 1040. Box 8, payer made direct sales of $5,000 or more. If this box is checked, $5,000 or more of sale of consumer products was paid to you on a deposit, commission, or other basis. A dollar amount does not have to be shown. Generally, you report any income from your sale of these products on Schedule C or CEZ. Box 10, crop insurance proceeds. Report this amount on line 8 of Schedule F for farming. And here is the first password of today's session. It is the password to open the Session 16 quiz answer key, and the password is Kirk, K-I-R-K, as in Captain James T. Kirk. Schedule C, Form 1040. Schedule C is a 2-page form that is used to report income and expenses of a sole proprietor. That is a single owner business. Now, in certain situations, it is possible for a husband and wife who run a business together to file Schedule C. But what the IRS says is you can't have the Schedule C be in the name of two people. So here where it says name of proprietor, you would only ever have the name of one spouse. And that means if both spouses run a business together, they have two choices. One is they can file a partnership return, or the other is they can split the income and expenses between them and they each file their own Schedule Cs. So we're going to take a look at Schedule C for the next bit of today's class. We're going to look at each section of this tax form in turn and get to know it a little bit better, and in particular how we make decisions about what kind of numbers to enter on the various lines. We have Part 1 where we enter income, Part 2 where we enter expenses. Down at the bottom, we total up expenses. There's space provided to enter office use of home expenses. Then on page 2, in Part 3, we record cost of goods sold information. In Part 4, we enter information on automobiles. And in Part 5, we list all other expenses being claimed for the business that have no space provided for them here on these lines 8 through 27. And let's begin at the very top of Schedule C, page 1, and we're looking at this section right here. Items A through H are used to report information about the kind of business you own, the method of accounting you use, and whether you materially participated in your business. If you have an employer ID number for your business, report your EIN in Box D, right here. If you received a 1099 miscellaneous from a customer, do not report your customer's EIN in this box. It's for your EIN, and if you don't have one, you leave it blank. But you don't ever put the EIN that appeared on a 1099 miscellaneous that was issued to you by a customer, for example. And I also wanted to point out to you here that we have check boxes that you need to enter your accounting method as either cash accrual or other. Question number G, did you materially participate in the operation of this business? This has to do with whether or not you are actively participating in the operation of your business. And if you are not actively participating, then it would be a passive activity. So most sole proprietors will check yes to this question. And then question number H, if you started or acquired this business during 2010, check here. And of course, it's a new business only. You would check that box. Now, I did want to point up here at the top, Box B. Enter the code from pages C9, 10, and 11. Well, what this is referring to is the instructions for Schedule C. So let me just show you a minute let me show you what that is referring to. So I have up in front of you here the form instructions for Schedule C, and a large part of what I'm teaching you in today's lecture is coming from this form, or rather these form instructions. So watch the lecture and read the manual, but if you have any more questions about what goes on a specific line, you can refer to these instructions for Schedule C, and you can also refer to IRS Publication 334 for small business. Let me get to the page that we're talking about where we have these codes listed. And the principal business or professional activity codes begin on page C9. And what you need to do for a client is you need to read through the list of codes and select a code appropriate to the type of business activity your client is operating or engaging in. For example, if you have a client who is running a restaurant, then you would look at food, services, and drinking places. And the options are a drinking place, like a bar. Another place is a full-service restaurant. Then we have limited service eating places. That would be like fast food restaurants. And then we have special food services, including food service contractors and caterers. So that's an example of the type of food services and drinking places codes that are available. On the next page, we have educational services. We have professional, scientific, and technical services. And under professional services, if you look, you'll actually find tax preparers. Now, interestingly, when I first entered this field back in the early 90s, there was no code for tax preparers, which I thought was rather ironic. They did have a code for accountants, but they didn't have one for tax preparers. But sometime around the late 90s, I believe, they came out with a code finally. And of course, this is page 3 of the code. And somewhere amongst all of these codes, you need to find one that seems to closely approximate the type of business activity your client is engaged in or is engaged in. Now, you look down here, we finally have a code 9999999, unclassified establishments unable to classify. I frequently see tax preparers use that code, and it's most cases it's just simple sheer laziness, can't be bothered actually looking up the proper code, but you are responsible for entering the proper code on the return. So moving down to the next part of Schedule C, we're going to take a look at Part 1. And in Part 1, the first line we come to is Line 1, Gross Receipts or Sales. On this line, you should enter your gross income or sales earned before expenses. And let's just see. It says, caution, see instructions and check the box if this income was reported to you on Form W-2 and the statutory employee box on that form was checked. Or you are a member of a qualified joint venture reporting only rental real estate income not subject to self-employment tax. Also see instructions for a limit on losses. Then on line 2, you report your returns and allowances. So if you refunded money to your customers, this is where you would report that. Next, you subtract line 2 from line 1, and you enter the total on line 3. Then we have cost of goods sold, and I'm going to get to cost of goods sold in a little bit. It's farther down the form. But the amount that you figure for cost of goods sold on page 2 of Schedule C is carried over and entered here on line 4. You subtract cost of goods sold from your income, and you get your gross profit that is entered on line 5. The amount that you enter on line 4 is the amount that you figured and entered on line 2 on page 2 of Schedule C. You have cost of goods sold if you sell a product you manufactured or purchased from others, and you calculate your cost of goods sold by subtracting your closing inventory for the year from your opening inventory for the year and adding to that any purchases that you made for the year. So the cost of goods sold section of Schedule C basically walks you through the steps of doing that calculation. And once you've figured that number, you go ahead and enter it on line 4 as cost of goods sold. You subtract line 4 from line 3, and you get your gross profit. And then we have line 6, where we enter certain other types of income, including federal and state gasoline or fuel tax credit or refund. And in certain situations, you might have a recapture of depreciation that was reported on Form 4797 that would enter on this line. So, for example, if you claimed a Section 179 deduction on an asset that fell to less than 50% business use, that particular recapture is figured in Part 4 of Form 4797. And if you have an entry in Part 4 of Form 4797, that would carry over to line 6 of your business and get entered on that line. Finally, on line 7, you have your gross income from the business. Other items that you would enter on line 6 include things like recovered bad debt, state business tax refunds you previously deducted as a business expense, prizes, awards, and other kinds of miscellaneous income from your business. Then on line 7, you add lines 5 and 6 to determine your gross income before any expenses. And here we are into Part 2 of the form. A key point to remember about Part 2 is nowhere in Part 2 will you ever enter office use of home expenses. Those are specifically reserved as to not be reported in this section. They are reported first on Form 8829. So if you have any expenses relating to office use of a home, do not include them in Part 2 of Schedule C. We're going to take Part 2 line by line, and the first line we're looking at here is advertising. Enter the cost of yellow page, radio, or television ads, direct mail, and other promotional costs of your business here. Then on line 9, you enter car and truck expenses. If you claim any car or truck expenses, you must provide information by completing one of the following: Schedule C, Part 4, or Form 4562, Part 5. You can use Part 4 of Schedule C if you are claiming the standard mileage rate. You lease your vehicle or your vehicle is fully depreciated, and you are not required to file Form 4562 for any other reason. If you used more than one vehicle during the year, attach your own schedule with information requested in Schedule C, Part 4 for the additional vehicles. And here is an illustration of Part 4 of Schedule C, where you can enter information on your vehicle. But complete this part only if you are claiming car or truck expenses on Line 9 of Schedule C, and you are not required to file Form 4562 for this business. See the instructions for Schedule C for Line 13 to find out if you must file Form 4562. And of course, this is what Part 4 of Schedule C looks like. Underneath, I have a cutout of Part 5 of Form 4562. And you must use Part 5 of Form 4562 if you are claiming depreciation on your vehicle or you are otherwise required to file Form 4562 for any other reason. Now, at the bottom of Part 5, you will see that there are a series of questions where you answer or provide information about the use of your vehicle. And these questions that you must answer: was the vehicle available for personal use during your off-duty hours, yes or no? Was the vehicle used primarily by a more than 5% owner or related person, yes or no? You will see that up above, those same questions are being asked in these checkboxes here. You either do Part 4 of Schedule C or Part 5 of Form 4562, but you would never fill them both out. Anytime you ever claim auto expenses on Schedule C, you must either complete Part 4 or Part 5. And Part 4 has a number of situations where you cannot use it, one of those being if you are required to file Form 4562 for any other reason. So, of course, never enter a number on Schedule C on Line 9 without also completing Form 4562 Part 5 or Schedule C Part 4. If you do not do what you're supposed to in that regard, the IRS will reject your tax return or disallow the auto expenses you are claiming. On Line 10 of Schedule C, we report commissions and fees. If you paid commissions and fees to other individuals or businesses, report the amount here. Note, if you paid an unincorporated business $600 or more, you must issue Form 1099 Miscellaneous, Box 7, Non-Employee Compensation to the party you made payment to. And the IRS is really getting down on this. If you have numbers on Line 10 or Line 11, right here, Contract Labor, and you did not issue a 1099 Miscellaneous, you're probably going to get an audit letter. The odds of it just go astronomically up because the IRS is looking, as a part of really a congressional legislation that has been passed, to increase compliance. And it is very easy to enter expenses on these lines that you either did not pay or were really paid out, but were paid to a person who themselves is not reporting the information on their tax returns. So IRS wants to be able to see that if you enter an expense on Line 10 or Line 11, that the people who you paid money to are filing tax returns and reporting that as income. And so we're really going to be seeing a movement on the part of the IRS towards increased compliance. Now, you are only required to issue a 1099 Miscellaneous to someone whom you paid more than $600 to during the year. So it's technically possible to have numbers on Line 10 or 11 with no corresponding 1099 Miscellaneouses being issued. But what I caution you about is the amount that's on Line 10. Obviously, as soon as Line 10 goes over $600, the IRS could begin to take a look at it. And once you're getting into the a few $1,000s amounts on Line 10 or Line 11, it's pretty much impossible to be paying out a few $1,000s a year in expenses, in commissions and fees and contract labor to individuals without having at least one of those individuals go over $600. On Line 11, we enter contract labor. You deduct expenses on this line that you paid for services performed by non-employees. And note again that if you paid an individual $600 or more for contract labor or services performed for your trade or business, you must issue a 1099 Miscellaneous with income reported in Box 7. Line 12 is for depletion. If you harvested trees, you must attach Form T for timber and claim your depletion expense here. But I did want to point out that this is if you are in the business of, you're basically in the lumber industry. You do this on a commercial basis. If you're just an independent owner of some land and you have some timber on the land and you have a company come in and cut it down and sell it, you're not in the business of timber. You're selling off a capital asset that you own, and that capital asset sale is reported on Schedule D, and no Form T is required. So Form T relates to income reported on Schedule C for a person who is actually in the business of commercial logging. Line 13. Depreciation and Section 179 expense deduction. If you placed property in service or had listed property in service during the year, you must attach Form 4562, Depreciation and Amortization. Otherwise, you must maintain an accurate depreciation schedule for your records, which shows how you calculated your depreciation deduction. Line 14, Employee Benefit Programs. Enter the cost of accident and health plans, group term life insurance, and dependent care assistance programs you paid for your employees here. Do not claim any expenses that you paid for yourself. You may claim expenses you paid for your spouse or other members of your family, only if they were your employees and were issued a W-2. Health insurance premiums paid by self-employed persons may be deducted as an above-the-line deduction on Form 1040, line 29. The deduction is limited to net profit from Schedule C minus deductions for 1/2 of self-employment tax and contributions for the sole proprietor's benefit to a SEP simple or qualified plan. Insurance other than health insurance. Deduct liability, hazard, and workers' compensation insurance here. Line 16, interest. Mortgages paid to banks, etc. If you own mortgaged property such as an office building and received a Form 1098 or similar statement, report the amount of interest you paid here. Do not report mortgage interest you paid on your home, however. Or B, other, interest on credit cards used exclusively by your business, mortgage interest paid on business property, and no Form 1098 was issued, as well as any other interest you paid on business loans is reported on this line. Line 17, legal and professional. Tax preparation, legal, accounting, and related expenses of your business would be entered here. And again, when you're dealing with legal and professional fees that you've paid out, if you paid an individual who is not a corporation more than $600 during the year, you will need to issue them a 1099 miscellaneous. Oddly enough, if you pay an attorney, regardless of whether that attorney is incorporated or not, you are always supposed to 1099 attorneys. Line 18, office expense. Office supplies and postage are entered on this line, along with other things relating to your office-type expenses. Line 19, pension and profit-sharing plans. If you have a pension or profit-sharing plan for your employees, enter the amount of any contributions you made to the plan here on line 19. Line 20, rent or lease. Vehicles, machinery, and equipment. If you rented or leased vehicles, machinery, or equipment, enter the amount here. If you lease a vehicle for a term of 30 days or more, you may have to reduce your deduction by an inclusion amount. B, other business property. Amounts you pay to rent or lease office space or a building are entered here. Do not include amounts you spent for office use of your home on line 20B. I should point out as well that if you are renting space for your business from an individual and you paid more than $600 of rent to that individual during the year, then you should be issuing that individual a 1099 miscellaneous and reporting the amount you paid in box 1 as rents paid. Line 21, repairs and maintenance. The cost of labor and supplies used to maintain or repair business property is reported on this line. Do not include repairs to office use of home. Do not include improvements to property that change or extend its useful life, and do not deduct the value of your own labor. Line 22, supplies. Supplies are items that you consume or use up, and examples of supplies include small tools with a useful life of 1 year or less used by a furnace installation business, for example, or shampoo, conditioner, and perming solution used in a beauty salon. Also, meal expenses incurred by child daycare and adult foster care providers are supplies and should be reported on this line. If you provide meals to your employees or customers or patients in the normal course of your business, you should claim this expense as a supply expense and not as a meal or entertainment expense subject to the 50% limit. Standard meal and snack rates for daycare providers. For tax years beginning in 2003, instead of using actual costs, family daycare providers can use the standard meal and snack rates to compute the deductible cost of meals and snacks provided to eligible children. The standard meal and snack rates can be used for a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day. Note that a family child care provider who receives a reimbursement for a particular meal or snack can deduct only the portion of the applicable standard meal or snack rate that exceeds the amount of the reimbursement. Family daycare providers defined. A family daycare provider is a person engaged in the business of providing family daycare. Family daycare is child care provided to eligible children in the home of the family daycare provider that meets all of the following requirements. The child care is non-medical. A transfer of legal custody is not involved, and the child care generally lasts for less than 24 hours each day. Eligible children. Eligible children are minor children receiving family daycare in the home of the family daycare provider. Eligible children do not include children who are full-time or part-time residents in the home where the child care is provided, or children whose parents or guardians are residents of the same home. For example, a family daycare provider's own children and any children who live in the family daycare provider's home on a full or part-time basis are not eligible children, even if they receive daycare services from the family daycare provider. And here are the standard meal and snack rates that family daycare providers can use, and this applies only to family daycare providers. For example, it does not apply to home elderly care providers, only to child daycare. The following table shows the rates for 2010, and the U.S. Department of Agriculture does update this table once each year on July 1st. You have to look to the region of the country you are in. If you are in any of the 50 contiguous states, the amount allowed for breakfast is $1.19, lunch is $2.21, dinner is $2.21, and snacks are 66 cents each. You will observe that Alaska and Hawaii each have higher rates because those parts of the country are more expensive for food. A family daycare provider who chooses to use the standard meal and snack rates for a particular tax year must use the rates for all deductible food costs for eligible children during that tax year. For more information, you should refer to Publication 587 for business use of your home. Here is an illustration. Sandy Muffet runs Little Tuffet's daycare from her home, and during the year she cared for the following children who were with her for the following number of days and meals. She had Jack, Jill, Hansel, and Gretel. And this is the number of breakfasts she fed each child, the number of lunch she fed to each child, the number of dinners to each child, and the number of snacks to each child. She's totaled these up at the bottom. We have 250 breakfasts, 250 lunches, 50 dinners, and 500 snacks. So how do we figure that out? Well, we go over here. Breakfast at $1.19 times $250 gives us $297.50 as an allowance for breakfast. Lunch gives us $552.50, dinner $110.50, and snacks $330. So the total deduction that Sandy Muffet can claim for her Little Tuffet daycare as a supply expense for her business is going to be $1,290.50. Line 23, taxes and licenses. Real estate and personal property taxes, business license and regulatory fees, Social Security and Medicare and state payroll taxes that you pay for your employees, and federal highway use tax are examples of taxes to enter on this line. Common taxes paid by small business owners also include city, personal property, and payroll taxes. Do not include real estate taxes for office use of your home, self-employment tax, or federal or state income taxes on this line. Line 24, travel, meals, and entertainment. Travel includes things like the cost of airfare, taxi, train, bus, hotel, local transportation while traveling away from your tax home. Deductible meals and entertainment. On this line, enter your meal and entertainment expenses after deducting the non-deductible amount. For most people, the non-deductible amount is 50% of the allowable expenses for meals and entertainment. However, if you work in the transportation industry, including airlines, railroad, trucking, etc., you may be entitled to claim 80% of your allowable expenses. If you are claiming a meal per diem, enter the amount of per diem you calculated after deducting the appropriate percentage. Do not deduct the cost of club memberships, even if you use your membership to entertain clients. Also not listed here, but also not deductible, is the cost of renting a hall or other facility to conduct or hold an entertainment event for your clients, for example. Line 25, utilities. Gas, electricity, water, heating oil, and telephone are reported on this line. However, you may wish to list telephone as a separate expense on line 27. I've always felt that telephone is somehow different from other utilities because it varies or is factored for in different ways. You can include telephone on the utilities line, but I've just personally preferred for years to really only look at those main core utilities of gas, electricity, trash, water, heating oil, and pull telephone out as a separate amount. But it's okay to put it on the line. Now, of course, do not enter or include on this line the cost of your main home phone line if you work from your home. Also, do not include any of the utility costs for office use of home. Line 26, wages. Enter the total salaries and wages you paid to employees for the tax year. Do not include salaries and wages deducted elsewhere on your return or amounts paid to you. Reduce your deduction by any wage credits that you claimed. Line 27, other expenses, from line 48 on page 2. The other expense line allows you to give descriptions and amounts to other types of expenses that you had which do not fit into the categories provided on lines 8 through 26. You should use as many categories as you feel are necessary to accurately describe the expenses you are claiming. Do not use the category miscellaneous. If your expense does not have a category, describe the expense by its name. For example, internet access fees, subcontractors, photo production costs, etc. Now, one of the things that I do see, of course, is our clients do not know that they're not supposed to use the word miscellaneous unless we essentially train them to stop it. And so when I have a client that comes to me and they are giving me an expense called miscellaneous, the first thing I want to do is burrow into it and figure out what they think is miscellaneous. And it often includes things like depreciable assets. Oh, miscellaneous included a computer I bought this year. Well, that doesn't go anywhere except on a depreciation schedule, right? And they'll also include meals, they'll include entertainment, they'll include travel. They really have no clue that they're supposed to divide things up better than they do, and so they'll just slap everything into a category called miscellaneous. And the first thing I do is burrow into miscellaneous. I also burrow into meals and entertainment. I burrow into travel, because when a client claims travel expenses, they usually throw the cost of their meals into the travel expense. And remember, we have to pull meals out and separate those because only half of the meal expense typically is deductible. Similarly, office supplies. Very often clients will stick depreciable assets in the category called office supplies when those need to go on depreciation schedules. So other expenses is a place that you really describe exactly what it is that you're trying to put on that line. For example, I've dealt with, over the years, with photographers, and I might put their developing fees or developing costs as a description on that line. Line 29, tentative profit or loss. This is your net profit or loss before you claim business use of your home. If you have a loss, some or all of your business use of your home expenses may not be allowed. Line 30, expenses for business use of home, attached Form 8829. So essentially here, total expenses, line 28. Line 29 is your tentative profit or loss, and line 30 is where you enter expenses for business use of home. You may be able to deduct certain expenses for business use of your home if you claim business use of home expenses. You must attach Form 8829, which we will discuss a little bit later in today's class. Then on line 31, you enter your net profit or loss. If you have a loss, the amount of loss you can deduct this year could be limited. Go to line 32 before entering your loss on line 31. And of course, line 32 says, if you have a loss, check the box that describes your investment in this activity. And it's asking you, is your business all at risk, or is some of your investment not at risk? If some of your investment is not at risk, now we're getting to that at-risk limitation form 6198 in determining whether or not you'll be allowed to claim a loss on your business. Page 2 of Schedule C is where we get into cost of goods sold. And here is the cost of goods sold section of Schedule C. Generally, if you engage in a trade or business in which the production, purchase, or sale of merchandise was an income-producing factor, you must take inventories into account at the beginning and end of your tax year. If you are a cash-basis taxpayer with average annual sales of $1 million or less over the past 3 years, You are not required to account for your inventory. However, if you choose not to report your opening and closing inventory, you may not claim the cost of materials and other inventory items as a supply cost until the year you sell them. And if you have to track them to see if you sold them, you may as well just track cost of goods sold. Example, you operate a heating and cooling business. Your gross annual sales are under $1 million. You can choose to claim the cost of a furnace you are selling and installing for a customer by deducting the furnace as a supply on line 22 of Schedule C. However, you may only claim the cost of the furnace as an expense in the year you sell it to your customer. You may not claim a deduction for the cost of a furnace that you bought but have not yet sold. It is generally recommended that you keep records of your opening and closing inventories regardless of your sales. Cost of goods sold is generally a more accurate method of tracking costs. So now we're going to take a look at each of the lines on Part 3 of Cost of Goods Sold. You can see line 33, we use the method used to value your closing inventory, either cost, lower of cost or market, or other, and attach an explanation. Line 34, was there a change in determining quantities, costs, or other valuations? If yes, attach an explanation. And then we go on to inventory at the beginning of the year. Purchases less cost of items withheld for personal use. Oddly enough, if you purchase supplies for your business and then you consume them for personal purposes, that's not considered to be a business expense. Cost of labor, but don't include the amount you paid yourself. Materials and supplies, other costs, add them up, and then subtract out your end-of-year inventory. The result is your cost of goods sold. So let's take a little bit closer look at each of these lines. Beginning with line 33, the method used to value your closing inventory. You may use whichever method of valuing inventory provides the lowest value. However, if you use the cash method of accounting, you must use the cost method for valuing your inventory. The three methods available to value closing inventory include cost, lower of cost or market, or other method, but attach an explanation. Line 34. Changes in determining quantities, costs, or valuations between opening and closing inventory. Was there a change? Answer yes or no. This usually pertains to a change in a method of accounting, such as last in, first out, to first in, first out, and then refiguring last year's closing inventory using the new method, and entering the result on line 35 and attaching an explanation. This is a fairly advanced accounting concept, and really a business to even know to begin how to do this would really need to be using an experienced accountant, probably a CPA. Line 35, inventory at the beginning of the year. Your opening inventory should be the same as your closing inventory for the prior year unless this is your first year in business. Purchases less cost of items withdrawn for personal use. Enter the total cost of all items you purchased for sale to customers or as components in the manufacture of your product. Do not include the cost of any items that you took for personal use. Cost of labor. Do not include any amounts you paid yourself. Enter the cost of wages you paid to employees to manufacture or sell your products. Line 38, materials and supplies. The cost of materials and supplies you use to manufacture your product is entered here. Examples include food used by a restaurant or materials used by a production line. Line 39, other costs. Other costs relating to the sale of your goods would go here. Line 41, inventory at the end of the year. The cost or fair market value of all inventory you had on hand at the end of the year is entered here, and that means you have to do a physical count of your year-end inventory to know how much to enter on that line. And line 42, cost of goods sold. Your cost of goods sold is calculated by subtracting your closing inventory from the total of the amounts shown on lines 35 through 39. Next up, we're going to take a look at Part 4, information on your vehicle. We've already talked about this, and you only use this part if you used your car for business and you were not otherwise required to file Form 4562. You may only report information about your auto directly on Schedule C if all of the following are true. You used only one car for your business, but you can attach your own schedule with the information requested in Part 4 for additional vehicles. And you did not place depreciable property in service during the year, and you did not claim a depreciation deduction for listed property in use during the year. Part 5, other expenses. Other expenses you claim on line 27 of Schedule C are itemized here. List the type and amount of each expense separately in the space provided. Do not include the cost of business equipment or furniture, replacements, or permanent improvements to the property, or personal living and family expenses. Do not include charitable contributions. You may not deduct fines or penalties paid to a government for violating any law. If you are claiming a deduction for amortization, you must complete and attach Form 4562. And now we're up to the other expense category, and I actually just put some items here. List items here for which no line description is provided in Part 2, and examples are, for example, Internet access fees, subscriptions, and continuing education. Schedule K, merchant card and third-party network payments. Beginning with tax year 2011, credit card and third-party network transaction providers must begin to issue Form 1099-K to merchants and payees who complete 200 or more payment transactions during the year, and those transactions total more than $20,000. So this is a new form. It isn't even out yet, and it really isn't a part of 2010 tax law, but I feel like I can't ignore it because you're going to finish my course and head straight into a tax season where you're immediately going to be seeing these documents. So I wanted to introduce you to them, and we'll cover them, of course, in our 2011 update class when I teach that in January. But this particular form is new, and it is another part of the government's effort to bring businesses into compliance and begin reporting their income. And I believe that it is specifically targeting a lot of people who have been making a good business about selling products on eBay. And they basically run businesses from their house, they buy and sell, and they're bringing in a lot of revenue off eBay, and they're not reporting it anywhere on their tax returns, basically thinking it's tax-free money. Well, watch out. eBay is going to start nailing those people, maybe not on purpose, but indirectly the IRS is going to be finding out about all these transactions. And, of course, if all of a sudden a person has $20,000 of transactions being reported on eBay sales, that's going to be something that they're going to have to be dealing with filing tax returns. It's all going to be interesting to see what kind of statistics come out on this. The new 1099-K form requires entities who act as the middleman in payment transactions to report these transactions to the IRS. Credit card companies, PayPal, and other middlemen parties who collect money for businesses will issue Form 1099-K to the businesses and report annual transactional amounts to the IRS. Amounts reported in Box 1 of the form up here should be included in the gross receipts of the business owner. If you received Form 1099-K and you are filing Schedule C, include the amount shown in Box 1 on Line 1 of Schedule C. If you are a business owner who is required to issue a 1099 miscellaneous to a subcontractor or vendor you made payments to, do not include on the Form 1099 miscellaneous any amounts that you paid via credit card or through a third-party network provider in 2011 or later years, because these amounts will be reported to the IRS by these third-party providers. So essentially, if you pay cash or you write checks to a vendor, then you would report those payments to that vendor on a 1099 miscellaneous. But if you pay your vendor through credit card charges or through PayPal, for example, or you purchase it on eBay or Amazon.com, those third-party entities are going to be reporting those transactions directly to the IRS. So you don't want to be doubling it up or duplicating reporting by filing a 1099 miscellaneous for the exact same amounts. I think that there's going to be kind of a mess there for a period of time until people get it all figured out. And moving on to the next topic of the day, we're going to be looking at office use of home and how and when you are allowed to claim expenses for having a home office. If you used a part of your home for your business, you do not deduct the expenses for business use of your home directly on Schedule C, and you have seen that throughout the course so far today, that we've been looking at the line items from Schedule C, and line after line says, do not report expenses for business use of your home on this line. Do not report business expenses for use of your home on this line, over and over again. And the reason is, if you are allowed to claim home office expenses or home business use of your home expenses, you do so on this Form 8829. So this is Form 8829, and you can see that it's a multi-part form. We have Part 1 where you figure the business percentage use of your home. Then in Part 2, we enter the allowable expenses for business use of our home. In Part 3, we figure depreciation on the home. And in Part 4, we enter any disallowed expense from the prior year that resulted in a carryover to 2011. So we're going to take business use of home section by section or part by part and learn how to fill this particular form out. Generally, you may deduct business expenses that apply to a part of your home only if that part is exclusively used on a regular basis. Number 1, as your principal place of business for any of your trades or businesses, or as a place of business used by your patients, clients, or customers to meet or deal with you in the normal course of your trade or business, or in connection with your trade or business if it is a separate structure that is not attached to your home. There are 2 exceptions to this rule, that is, exclusive business use, and they are if you use an area of your home for inventory storage or to operate a daycare business. Inventory storage. You use this space on a regular basis to store inventory or product samples, and your home is the only fixed location of your trade or business. So if you need to store inventory and your home is the only place that you do business from, on a fixed place that you do business from, then you can actually have an area of your home that you set aside for storage of inventory, and it doesn't have to be exclusive use. The other exception is when you run a daycare from your home, and in that instance where you have a home daycare, you don't have to show exclusive use. It's enough to show that the children are using your home, and they have a formula to help figure out what percentage business use you will be allowed because you run a daycare from your home. So what does principal place of business mean? Well, your home will qualify as your principal place of business for deducting expenses for its use if you meet the following requirements. Number 1, you use it exclusively and regularly for administrative or management activities of your trade or business. Examples include billing customers, clients, or patients, keeping books and records, ordering supplies, setting up appointments, forwarding orders, or writing reports. Also, you have no other fixed location where you conduct substantial administrative or management activities of your trade or business. And here is the Form 8829. We're looking first at Part 1, where you figure the part of your home that is used for business. You use this section to determine the percentage of your home that qualifies as business use. You may use the number of square feet in your home or any other method that accurately reflects the business use percentage. So for example, if your house has 10 rooms and you use 2 of them for business use, it would be reasonable to say that your home is 20% business use. But essentially what the IRS wants you to do is on line 1 to enter the area of your home that is used regularly and exclusively for your business, regularly for daycare, or for the storage of inventory or product samples. Whatever that area is, you entered on line 1. Then on line 2, you enter the total size of your home. Normally it would be done in square footage, but of course you could do a room count like I already said. So let's just suppose that you have a 200 square foot office, your home is 2,000 square feet. Well then on line 1 you would enter 200, and on line 2 you would enter 2,000, and you would divide 1 by 2, and you would enter 10% business use on line 3. Now, for daycare facilities not used exclusively for business, the instructions are to go to line 4. And on line 4, you're going to multiply the number of days that you used your home for daycare by the hours that it was used per day. So if you have children in the home for 10 hours a day and you use the home 5 days a week, 50 weeks out of the year, you would multiply that out and come up with a number of hours to enter on line 4. You will divide line 4 by line 5, and line 5 represents the number of hours in a year. And then you will get a percentage which you enter on line 6. You then take line 6, multiply it by line 3, and get the amount to enter on line 7. If you do not run a daycare, then line 3 would carry straight down to line 7. And here is an example. Mary Contrary used her basement to operate a daycare business for children. She figures the business percentage of the basement as follows. She takes the square footage of the basement, which is 1,600 square feet, and the total square footage of the entire house at 3,200 square feet. That gives her a ratio, or 50% business use. She used the basement for daycare an average of 12 hours a day, 5 days a week for 50 weeks of the year. During the other 12 hours of the day, the family could use the basement. She figures the percentage of time used for daycare as follows. The total number of hours used for daycare is 12 hours a day times 5 days a week times 50 weeks in a year, and that gives us 3,000 hours. We divide 3,000 by the number of hours in a year, 8760, and that gives us 34.25% of the time that the home is available for use, or that basement area is available for use, when it is in fact being used. Mary can deduct 34.25% of any direct expenses for the basement. However, because her indirect expenses are for the entire house, she can only claim 17.3% of her indirect expenses. And we get 17.13 by taking 34.25 and multiplying that by 50%. And here is Mary Contrary as she fills out the top part of 8829. She enters 1,600 square feet for the area of the basement, 3,200 square feet for the area of the house, and that gives us 50% business use on line 3. She enters the number of hours that the home is used for daycare, 3,000, divides that by the number of hours in a year to get the ratio of 0.3425. 34.25% multiplied by 50% gives us 17.13%. Next, we're going to look at Part 2, Figuring Your Allowable Deduction. If you already have a loss on your Schedule C, you may not use expenses for office use of home to increase your loss, nor may you use expenses for office use of home to create a loss on your Schedule C. Part 2 of Form 8829 is divided into 2 columns. Column A is where you enter direct expense. These are amounts that are 100% attributable to your home office. And in column B, you enter indirect expenses. These are expenses that are attributable to all areas of your home relatively equally. For example, heating, air conditioning, the mortgage interest, things like that. Those are allocable to the whole house. A direct expense would be the cost of repairing the doorknob on the door of your home office. An indirect expense is, of course, the cost of electricity used to heat your entire home, including your home office. Claiming expenses for amounts allowable as deductions on Schedule A. Deductible items listed on lines 9, 10, and 11 are separated from other deductible expenses allowed on Form 8829. The amounts entered on lines 9, 10, and 11 are amounts that are allowable as itemized deductions on Schedule A. You must subtract the allowable expenses claimed on Form 8829 from the amount of property taxes and mortgage interest you paid. The difference is allowable as an itemized deduction on Schedule A, and the same applies to casualty losses that you might be claiming. So line 9 is a casualty loss line. That's where you enter your casualty loss. Line 10 is deductible mortgage interest, and line 11 is where you enter real estate taxes. You can see those 3 lines being summarized right here in Part 2. Casualty losses, line 9, deductible mortgage interest, line 10, real estate taxes, line 11. And on line 12, you're asked to total those amounts and add them up. And then it says on line 13, multiply line 12 by the amount on line 7, and line 7, of course, is your business use percentage. Claiming expenses for amounts not allowed as deductions on Schedule A. The first line, that would be an item that you would claim as a home office expense that you're not allowed to claim on Schedule A, is insurance. And this includes mortgage insurance, liability, and hazard insurance for the home. But do remember that mortgage insurance that meets the test for qualified mortgage insurance is treated as an interest expense and is allowed on Schedule A. But other types of mortgage interest, for example, if your income is too high, would be disallowed on Schedule A. Line 18, rent. If you paid rent for your home, enter the amount you paid here. If your housing is provided free of charge and is not taxable, do not enter an amount here. On line 19, we have repairs and maintenance. These are expenses relating to the upkeep of your home. Line 20, utilities, electricity, water, sewer, gas, heating oil, garbage service, etc. Line 21, other expenses. Enter other business use of home-related expenses here. Line 22, you add up lines 16 through 21, and then on line 23, you multiply line 22, column B, by the business use percentage shown on line 7. Then on line 24, you enter a carryover of operating expenses from 2009 Form 8829. If any of your 2009 business use of home expenses were unallowed, enter your carryover from 2009 here. Part 2, figure your allowable deduction. And so we've talked about earlier, on the earlier page, The amounts that you can deduct on Schedule A include casualty loss, deductible mortgage interest, and real estate taxes. The amounts you cannot deduct on Schedule A are separated out and begin on line 16, and these are entered on line 16 all the way through line 32. Home office expenses reported on line 16 through 32 are deductible only to the extent of net income from self-employment. Expenses in excess of income must be carried forward to the next year. So the reason that IRS breaks these amounts out and separates them from the amounts shown up here is that if you have a loss that's triggered on Schedule C as a result of expenses that appear on line 16 through 32, then you will have a carry forward. Part 3, depreciation of your home. If you are claiming depreciation for the cost of the business use portion of your home, complete Part 3 of Form 8829. You must complete Form 4562, Depreciation and Amortization, for the first year you claim depreciation on your home, and in anywhere where you begin depreciating new improvements or appliances placed in service in your home. For other years, you must maintain a depreciation schedule and complete Part 3 of Form 8829. Part 4, carryover of unallowed expenses to 2011. If expenses for business use of your home create or increase a loss on your Schedule C, your home office expense deduction is limited to only those items which are deductible on Schedule A. Other expenses, such as utilities and repairs which are not deductible on Schedule A, can only be deducted in the current year if your business shows net income for the year. To the extent that your expenses claimed on lines 16 through 21 exceed your net business income for the year, you must carry forward your unallowed business use of home expenses to 2011. Report your loss carryover on lines 42 and 43 from your 2010 Form 8829. So the next topic we're going to take a look at is deductible business expenses, and we really spend a lot of time talking about how you determine whether or not an expense is deductible or not in our session on employee business expenses. And all of the different rules we talked about there, that is, how you establish whether a meal or entertainment expense is deductible, how you establish whether a travel expense is deductible, those rules. They're all the same for Schedule C as they are for Form 2106, so we're not going to repeat them here. So if you have a question about, hey, is this item deductible or not, return back to our session on employee business expenses and reread those paragraphs. But there's one exception that we wanted to point out to you where there is a difference between Schedule C rules and Form 2106 employee business expense rules. And that is interest on car loans. Because if you are an employee claiming business expenses on Form 2106, you are never allowed to deduct the cost of interest as an employee business expense. Interest on car loans is personal interest, and personal interest is not deductible. Also, interest that you might pay on credit cards is considered to be personal interest and is not deductible. But if you are self-employed, you are allowed to claim the cost of interest on the business portion of your car loan as a business expense on Schedule C, and you are also allowed to claim other forms of interest as a business expense on Schedule C. So if you have, for example, a business loan or business credit cards that have paid interest, those amounts can be deducted on Schedule C. Next, we're going to talk about the Domestic Activities Production Deduction. The American Jobs Creation Act of 2004 created the deduction for income attributable to domestic production activities. The deduction became effective beginning in tax year 2005 and is to be phased in over a period of 5 years. The deduction percentage for 2005 and 2006 was 3%. For tax years 2007 through 2009, the deduction percentage increased to 6%, and for 2010 and beyond, the percentage is set at 9%. The deduction is the applicable percentage of the lesser of the qualified production activities income, also referred to as QPAI, of the taxpayer for the taxable year, or the taxable income determined without regard to Section 199 for the taxable year. For 2010, you may be able to claim a deduction of up to 9% of your qualified production activity income from the following activities: construction of real property performed in the United States, engineering or architectural services performed in the United States, any lease, rental, sale, exchange, or disposition of tangible personal property, computer software and sound recordings that the taxpayer manufactured, produced, grew, or extracted in whole or in significant part within the United States, any qualified film produced by the taxpayer, electricity, natural gas, or potable water produced by the taxpayer inside of the United States. In certain cases, the reference to the United States also includes Puerto Rico. Your deduction may be reduced if you had oil-related qualified production activities income. The deduction does not apply to income from the sale of food and beverages prepared at a retail establishment such as a bar or a restaurant, or to property leased, licensed, or rented for use by a related person, or to the transmission or distribution of electricity, natural gas, or potable water, or the lease, rental, license, sale, exchange, or other disposition of land. Who qualifies for the deduction? You qualify to claim the deduction if you are reporting income on your Form 1040 return that includes qualifying income from Schedule C, partnership income from Form 1065, or shareholder income from an S corporation, and the business has a positive amount of income from a qualified domestic production activity, you have positive taxable adjusted gross income, and you paid a positive amount of wages to employees of your business. So how do you calculate the amount of the deduction? The deduction is calculated on Form 8903, Domestic Production Activities Deduction. To calculate the deduction, it is necessary for a business to separate gross receipts and production costs of the qualifying domestically produced activity from other non-qualifying income and expenses of the business. There is a safe harbor rule that allows taxpayers to treat all gross receipts as domestic production gross receipts if non-DPGR income is less than 5% of the total gross receipts. So what that means is you are supposed to keep track of how much of your income comes from a domestic production activity and how much of your income comes from other sources that are not production of income. For example, you might manufacture a product and you might also maintain a retail store where you resell items, including your own product. And the IRS wants you to keep track of those two separate income and expense flows separately. However, if you can show that the retail part of your business is 5% or less of your overall business income and expenses, then it's considered to be really de minimis and not something you need to track. Your domestic production activities deduction is the lesser of your domestic activities production income multiplied by 9%, or 50% of the W-2 wages paid. So we've put this in a little chart for you. The 2010 domestic activities production deduction is the lesser of 9% of qualified production activities income, or 9% of taxable income, and is limited to 50% of the W-2 wages. How to claim the domestic production activities deduction? Well, to claim it, you complete Form 8903 and enter the amount of the deduction on Form 1040, line 35. So this is a rather interesting deduction. It is a deduction that relates to business income, and so it would make sense that you should claim the deduction on the business return. However, you don't. You claim it on 1040 as an adjustment to income. And here's an illustration. Jacob owns a furniture manufacturing business with the following income and expenses for the year. He had gross receipts of $100,000, his cost of materials is $30,000, he paid wages of $25,000, and had a net profit from his business of $45,000. Jacob also has other income, and his AGI without the domestic production activities deduction is $51,821. Go ahead and prepare his Form 8903. And here we have the Form 8903. Jacob's allowable deduction is going to be the lesser of 50% of the W-2 wages he paid, or his adjusted gross income without regard to the domestic production activities deduction, or his net income from the domestic production activities deduction, multiplied by 9%. So let's take a look here at what's going on. On line 1, we enter the gross receipts of the business. On line 3, we enter the expenses related to that business income. And on line 6, we arrive at our profit of $45,000. The next step is to carry that $45,000 to line 10B, because this is Jacob's net income from the domestic production activities. Then on line 11, we enter his AGI without the domestic activities deduction figured into it. We enter the lesser of those two numbers on line 12 and then multiply the result on line 12 by 9%. That gives us $4,050. We carry that number down to line 15 and enter it on line 15. The next step is to look at the amount of wages that he paid for the year. and the wages he paid were $25,000. He enters those on lines 16 and 18 and 20. He then multiplies that figure of $25,000 by 50% and enters $12,500 on line 21. Well, his qualified domestic production activities deduction is going to be the lesser of the amount shown on line 21 or the amount shown here up on line 15. The lesser of those numbers is, of course, the $4,050 figure, and therefore that is his domestic activities production deduction. He's going to carry that deduction down and enter it on line 35 of his Form 1040. Next, we're going to talk about business credits, quite briefly though. Business credits are one of the more complex aspects of preparing a business tax return, and in this basic tax course, I'm going to just mention the business credits that are out there, but we're not really going to spend any time learning to calculate them. Once you're past the basic tax course, and if you find that you're doing business tax returns and you would like to know more about business tax credits and how to compute them, who qualifies for them and who doesn't, we do have a CPE course called Tax Credits for Business. And that is a more advanced course. The reports we're getting back from students who take it is that it's really a great course. They like it, but they're also saying it's quite difficult. So it's a course that you want to work your way up to. And therefore, at this basic level, I'm going to introduce you to the concept that there are business credits and basically the names of many of them, but we're not going to go into any detail at all on how to compute them or who qualifies for them. So your business may qualify for something called the general business credit. And all of the following credits, with the exception of the electric vehicle credit, are a part of the general business credit. The form you use to figure each credit is shown below, and in most cases you must include both Form 3800, the general business credit form, and the form used to calculate the credit with your return. And of course, Form 3800 is the general business credit form, and any of the credits that are listed next are basically claimed on that form, but they have another form that goes with them. Starting with Form 3468, the investment credit. We also have the American Samoa Economic Development Credit, the Work Opportunity Credit, the New Hire Retention Credit, the credit for alcohol used as a fuel, the credit for increasing research activities, the Low-Income Housing Credit, the Recapture of Low-Income Housing Credit, the Orphan Drug Credit, the Disabled Access Credit, the Qualified Electric Vehicle Credit, Part 1 only, the Renewable Electricity Production Credit, the Empowerment Zone Employment Credit, the Indian Employment Credit, the credit for employer Social Security and Medicare taxes paid for certain employee tips, Biodiesel and Renewable Diesel Fuels Credit, the New Markets Credit, the credit for small employer pension plan startup costs, the credit for employer-provided child care facilities and services, low sulfur diesel fuel production credit, qualified railroad track maintenance credit, distilled spirits credit, the non-conventional source fuel credit, the energy efficient home credit, the alternative motor vehicle credit, the alternative fuel vehicle refueling property credit, the mine rescue team training credit, the agricultural chemicals security credit, the carbon dioxide sequestration credit, the qualified plug-in electric drive motor vehicle credit, and the credit for small employer health insurance premiums. Your general business credit for the year consists of your carry forward of business credits from prior years plus the total of your current year business credits. In addition, your general business credit for the current year may be increased later by the carryback of business credits from later years. You subtract this credit directly from your tax. The Small Business Jobs Act of 2010 allows general business credits of eligible small businesses to offset both regular tax and alternative minimum tax for tax years beginning in 2010. Such eligible small business credits determined in the first year in 2010 are carried back 5 years. For more information, see Special Rules for Eligible Small Business Credits in the instructions for Form 3800 General Business Credit. Reporting requirements for employers is the next topic of the day. And as an employer, you have a responsibility. That is, if you own a small business and you have employees in your business, you have a lot of legal responsibilities, tax-wise and otherwise, with regards to those employees. An employee is a person who performs services under the direction and control of an employer. And remember this simple rule of thumb. If you are able to direct a person by controlling where, when, and how they work, then you probably have an employee. It does not matter if your employee works from home, that is their own home, or uses his or her own tools. What matters is whether you, as the employer, control the method and manner in which your employee provides services to you. Now, one of the most common things I run across with my clients on both ends, that is, one end being I have a client who is a business owner who has an employee or employees, and on the other hand, I'm dealing with people who are employees of business owners, is getting both sides of that equation to understand that an employer and an employee do not get to agree between themselves on whether or not they are employees or employers. That is the definition of it. If an employee works for an employer, what I mean by this is they can't decide, oh, well, we're just going to do a 1099 on you and you're going to pay your own taxes. It's illegal. You don't get to decide what the law is, any more than, say, you come to a red light and there's a car parked next to you and you say, hey, dude, why don't we agree between us today that red means go and green means stop? You don't have the ability to change laws like that. Red means stop, therefore you stop. And you cannot make an agreement between yourselves and other drivers as to what red means and what green means. The law dictates what is what. So you take that very simplistic concept of the law is the law, now move over to payroll laws and employment laws. And an employer does not get to decide what those laws are. And an employee does not get to decide what employment laws are. The law dictates when a person is an employee and when a business has an employee. It's our job as a tax preparer to recognize when an employment situation exists so that we can give good advice to our tax clients. So if we believe we're working on a tax return for a small business owner, and based on what that owner is telling us, we think that they have an employee, but they are 1099ing that worker rather than W-2ing that worker, then we have an ethical obligation to explain to them, hey, what you're doing is wrong. You could get in big trouble. If you go through a payroll audit, you're going to be in trouble. You're going to owe a lot of tax. You're going to owe penalties, and it won't be pretty. And I've seen payroll audits happen because a person got injured, not even on the job. We had a situation where a client was 1099ing these workers, and he'd talked to an attorney, and pretty much the attorney had agreed, yeah, we think you can 1099 these people. And along comes a day where one of these workers is not even on the job. He's somewhere else, gets hurt, goes to the hospital. And while he's in the hospital, workers' compensation comes along and does an interview and establishes that he has a job. And where does he work? And who does he work for? And the next thing you know, the small business owner is under audit. And it wasn't pretty. So there's various ways employers get caught on this. One is an employee files a tax return and essentially causes a conflict between the employer's tax return and the employee's tax return. Another is that the employer is randomly selected for a tax return audit, or the employer is selected for a payroll audit, or the employer is audited because of a workers' compensation claim. There are any number of reasons why a small business will get audited, and although the chances of any one of those audits is relatively small, when you add them all together, the odds that a small business will get audited in a 10-year period are reasonably high. So you might get away with it for 1 year, you might get away with it for 2 years, you might even get away with it for 10 years. But all of a sudden, 1 year, your number's up and you get caught. And how well you come out of that audit situation is going to depend on whether you understood the laws and whether you were applying the laws and following the laws. So we're going to talk a little bit about payroll today, because if you are an employer and you have employees in your business, there are certain reports and forms that you have to file. And we're going to begin with payroll tax forms 941 and 940. If you have employees, you are required to do all of the following. Withhold 6.2% Social Security tax and 1.45% Medicare tax from your employees' pay. Now, there's a special law in place for 2011 that has reduced that percentage rate of withholding to 4.2%. But all other years, it has always been 6.2%. Number 2, you are also required to file Form 941 every 3 months to report Social Security, Medicare, and federal income taxes withheld from your employees' pay. And number 3, when filing Form 941 as an employer, you must pay matching contributions of 6.2% Social Security tax and 1.45% Medicare tax. You must also pay federal unemployment tax by filing Form 940 FUTA, Federal Unemployment Tax, on an annual basis. Social Security Number Verification Service. The Social Security Number Verification Service is one of the services offered by the Social Security Administration Business Services Online. It allows registered users, that is employers and certain third-party submitters, to verify the names and Social Security numbers of employees against Social Security records. Registration is required through the URL you see here. So what is this about? What is it for? Well, there is a great deal of importance involved in getting Social Security numbers correct, and this online service is intended to help employers determine whether or not they have a match between an employee's Social Security number and the last name of the employee that the Social Security Administration has on record for that Social Security number. So verification of employee Social Security numbers is recommended for the following reasons. Correct names and Social Security numbers on W-2 wage reports are the keys to successful processing of your annual wage report submission. It is faster and easier to use than submitting your request's paper listings or using Social Security's telephone verification option. It results in more accurate wage reports. It saves you processing costs and reduces the number of W-2Cs. And it allows the Social Security Administration to properly credit your employee's earnings record, which will be important information in determining their Social Security benefits in the future. One final point is that if you file a W-2 with the Social Security Administration and there is a mismatch, well, Social Security is going to let you know that there's a mismatch. IRS is going to let you know that there's a mismatch. And if there's a mismatch, you may be ordered to do backup withholding on that employee's pay. Now we're going to talk about self-employment tax. And self-employment tax is pretty much the equivalent of payroll tax. It does the same thing. It causes you as a self-employed person to pay into your own Social Security benefit and Medicare funds. Self-employment tax is the equivalent of Medicare and Social Security tax. If you work as an employee, 12.4% Social Security tax and 2.9% Medicare tax is assessed against your wage income. The tax is divided 50-50 between you and your employer. Your employer will withhold half of each tax from your pay and make a matching payment on your behalf. For 2011, you will be assessed 10.4% Social Security tax against your wage income. 4.2% is withheld from your pay with your employer, contributing 6.2%. But if you are self-employed, you must pay self-employment tax on 92.35%. Deductions for dependents and deductions claimed on Schedule A for home mortgage interest, real estate taxes, charity, and medical expenses have no effect on the amount of self-employment tax you must pay, nor do any of the business credits that you might claim. Credits are used only to offset income tax and have no bearing on Social Security or Medicare tax. You calculate your self-employment tax by using the following formula. You begin by taking the net profit shown on Form 1040, line 12. You add to that the net profit from active participation in a partnership that you included on Form 1040, line 17. You multiply that total by 92.35%, and then you multiply that by 15.3%. That will equal the self-employment tax that you need to report on Form 1040, line 56. Now for 2011 only, this 15.3% figure is dropping to 13.3% because of the 2% reduction in Social Security tax for employees. And if you're self-employed, you get it on your half, or the employee half of the Social Security tax that you're paying. And here is an example. Wade's net profit shown on Form 1040, line 12, is $25,000. His self-employment tax is $25,000 of net profit multiplied by 0.9235 multiplied by 0.153, and that equals $3,533. Wade will enter $3,533 on Form 1040, line 56, as self-employment tax that he owes. Self-employed health insurance deduction. Normally, health insurance premium deductions also have no effect on the amount of self-employment tax you must pay. However, for 2010 only, you can reduce your net self-employment income by the amount of your self-employed health insurance deduction that is entered on line 29 of Form 1040 or 1040-NR. For self-employment income earned in 2010, The self-employment tax rate is 15.3%. The rate consists of two parts, 12.4% Social Security and 2.9% for Medicare. The 2010 Tax Relief Act reduced the self-employment tax by 2% for self-employment income earned in calendar year 2011. The self-employment tax rate for self-employment income earned in calendar year 2011 is therefore 13.3%. That is 10.4% for Social Security and 2.9% for Medicare. Self-employment tax is assessed on net earnings from self-employment and on wages and tax-free housing allowances provided to members of the clergy. To calculate your self-employment tax, complete and attach Schedule SE to your return. The Social Security component of self-employment tax is limited to the first $106,800 of wage and self-employment earnings for the year, but there is no cap on the amount of self-employment income that is subject to the Medicare portion of the self-employment tax. Let's take a look at completing Schedule SE, page 1. Schedule SE is a two-page form. However, you file page 1 or page 2, but not both. Schedule SE, Section A, page 1 is the short version of the form and is used by most filers. And here is the part of the form that you fill out. And you can see that it offers space to enter your net profit or loss from Schedule F, net profit or loss from Schedule C or CEZ, or from a K1 from a Form 1065, which is a partnership K1. Whatever that net profit is, you enter it on line 2. You then add up your farm profit with your other self-employment profit and enter that total on line 3. Then on line 4, you multiply that total profit by 92.35%. On line 5, you'll figure whether or not you've reached the threshold for income subject to Social Security tax. If you're able to see that your income exceeds $106,800, you're going to pay the Social Security component of the tax only on the first $106,800 of income you have from either wages or self-employment for the year. But if your income is less than $106,800, you'll multiply the amount on line 4 by 15.3%. And if it's less, then you do it by a lesser amount and add a number to figure the amount of Medicare tax you owe. Finally, on line 6, you figure the deduction for 1/2 of your self-employment tax. So let's see how this illustration turns out. So let's read through these lines in a little more detail. Beginning with lines 1 and 2. You need to know what to include as net earnings from self-employment. You should refer to Schedule SE instructions to determine the amount that you need to enter on line 1A and 2. On line 1B, if you receive Social Security retirement or disability benefits at the same time you receive Conservation Reserve Program payments, enter the amount of your taxable CRP payments on line 1B. These payments are included on Schedule F, line 6B, or listed on Schedule K1 from a 1065. Line 3, generally, a small business owner may not deduct the cost of health insurance when calculating self-employment tax. But for 2010, the Small Business Job Act allows a business owner to reduce his or her net self-employment income by the amount of his or her self-employment health insurance deduction entered on line 29 of Form 1040 or Form 1040-NR. Be sure to subtract this amount after you combine lines 1A, 1B, and 2, and before entering the result on line 3. If both you and your spouse are taking a deduction for self-employed health insurance on line 29 of a joint Form 1040, each of you subtracts on line 3 of your separate Schedules SE only the amount attributable to your own premiums. Note that the self-employed health insurance deduction is allowed on line 3 only if you have an entry or entries on line 1A and or 2 of either of the short or long Schedule SE forms. I'm going to have an illustration for you on the next page on how that works. Line 4. If line 4 is less than $400 and you have an amount on line 1B, combine lines 1A and 2. And if the total of lines 1A and 2 is $434 or more, file Schedule SE, completed through line 4 with your tax return. Enter 0 on Form 1040, line 56, or Form 1040-NR, line 54. But if the total of lines 1A and 1-2 is less than $434, do not file Schedule SE unless you choose to use an optional method for figuring your SE tax. Here is an illustration. Sam McGee has net income from self-employment of $100,000. He paid $10,000 for health insurance premiums for himself and his family. He is not eligible to participate in another employer plan. Prepare his Schedule SE as shown. Well, you can see that the top portion of Schedule SE is basically a flow chart to help you determine whether or not you can use the short Schedule SE or whether you have to use the long Schedule SE. Sam McGee qualifies for the short form, which was what we have filled out. We begin on line 2 by entering his net income from self-employment, and then on line 3, we enter his net income after subtracting out the self-employed health insurance premiums that he paid, which gives him $90,000 to enter on line 3. We then take line 3, multiply that by 92.35%, and enter the total on line 4, $83,115. Next, we take the total on line 4 and multiply that by 15.3%. That gives us $12,717. Then on line 6, we multiply line 5 by 50% and enter $63.59 on line 6. Line 5 carries to the back page of Form 1040 and is entered on line 56. This is the self-employment tax that Sam McGee owes. Line 6 is 50% of line 5, and it represents the deduction for 1/2 of the self-employment tax. Now, why is there a deduction for 1/2 of self-employment tax? Well, the reason for that is that normally when you are an employee, your employer pays half of your payroll tax for you. But when you're self-employed, you have to pay both halves yourself. And so there's a rationale that your income is lower than it otherwise would be because of the self-employment tax. So you get to deduct the half that you have to pay for yourself that would normally have been paid by an employer. Now, I did want to explain to you that for 2010, the fact that you are able to reduce your self-employment tax by the self-employed health insurance deduction, that's actually a pretty significant tax benefit that has been in place for 2010. Because if you look at the figuring we did here, we came up with a self-employment tax for Sam McGee of $12,717. But let's just see what would happen if we figured his self-employment tax on $100,000 rather than on $90,000. We would take $100,000, multiply that by 92.35%, multiply that by 15.3%, and that would give us self-employment tax of $14,130. Well, that is $1,430 less than the amount shown on line 5 when he does get to deduct his self-employed health insurance premiums. So for 2010, there was definitely a very significant one-time benefit in place that allowed for that self-employed health insurance deduction. And the second password of the day is the password to open the Session 17 homework answer key. The password is Sydney, Sydney. And I have here in front of you now page 2, or the long form version of Schedule SE. Schedule SE Section B, page 2 is the long version of the form, and you use the flow chart on page 1 to determine if you are required to use page 2. An example of a reason why you would be required to use page 2 is if you are a church employee with wages from a W-2, then you have to make an entry on line 5. And part 2 is where you can use an optional method to figure your net earnings from self-employment. It is possible that you could have gross income from self-employment but do not have a net profit from self-employment. And under the optional method, you can elect to report a certain amount of net income from self-employment for self-employment tax purposes, even though you do not in fact have a profit. And there can be some benefits to doing that. One benefit is that you are paying into the Social Security Fund for your retirement. And another benefit is it might make you eligible for earned income credit and certain other refundable credits. So you should complete Schedule SE Part B if you are a minister, member of a religious order, or Christian Science practitioner who received IRS approval not to be taxed on earnings from your religious work, but you owe self-employment tax on other self-employment earnings. Or you are using one of the optional methods to figure your net earnings from self-employment. Or you are a church employee with income reported on a W-2 of $108.28 or more. Or the total of your wages and tips subject to Social Security or railroad retirement tax plus your net earnings from self-employment is more than $106,800. Or you reported wages on Form 8919, uncollected Social Security and Medicare taxes on wages. Next up is city, state, and personal property taxes. Cities and counties frequently impose additional taxes on businesses. The taxes that may be assessed include income taxes on the business profits, sales and revenue taxes on gross sales, and/or personal property tax upon assets of businesses operating within their boundaries. Many cities in the United States require businesses to file some kind of city income tax returns. Many cities and counties assess personal property taxes against the value of your business assets. Some cities, counties, and states also impose business revenue taxes upon the gross sales of the business. One example of a revenue tax is Washington State's Business and Occupation Tax, or B&O tax. You should check with your local city and county to see if you are required to file city-county sales or personal property returns for your business. Now, most of this class we've been talking about Schedule C, and we're really going to be focusing on Schedule C for all of our assignments. Schedule F is really not a focus of our class, but we can't ignore it either. So I have a little bit of information here for you on Schedule F. And you file Schedule F if you are a farmer. And you are in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. A farm includes stock, dairy, poultry, fish, fruit, and truck farms. It also includes plantations, ranches, ranges, and orchards. Schedule F is the farmer's equivalent of Schedule C. Farmers use Schedule F to report income and expenses from farming. Do not use Schedule F to report rental income received from a tenant farmer. If you received rental income from a tenant farmer and did not otherwise participate in the farming activity, report your rental income and expenses on Schedule E. And here is Schedule F, profit or loss from farming, and you will see that it looks quite a bit different from Schedule C, but in the end it is accomplishing most of the same objectives. You enter your business code, you enter your accounting method, the name of your business, and so forth. But in Part 1, we have to talk about farm income under the cash method, and then we have farm expenses under both the cash and accrual method. We total up expenses and then move over on to page 2. And on page 2, we have farm income under the accrual method. And of course, for information on how to prepare Schedule F, that would be a whole course in and of itself. So I'm going to leave it at that today. But I did want to point out some of the unique rules that do apply to farming income and expenses. If you live in a rural area, you're going to have lots of farmers that are going to be walking in the doors of your tax office. If you live in an urban area like I do, you might see one farm tax return in 10 years. So it's a very regional type of return, of course. Now, a key thing to remember about farming is that the forms and attachments used with Schedule F are usually the same forms you use with Schedule C. For example, whether you are reporting business income and expenses on Schedule C for self-employment, Schedule F for farming income, Form 1120 for corporate returns, Form 1120S for S corporation returns, or Form 1065 for partnership returns, assets are depreciated using Form 4562. So we told you and taught you how to do a Form 4562 in our course, and we've shown you how to do Form 4797 in our course. And so a large part of what goes into a farming return is an understanding of all of the other forms that we've already been teaching you about. But having said that, it is also important to make note of special tax laws that are unique to farming income and do not apply to other types of business income. For example, farmers may not use the 200% declining balance when depreciating property, and instead the 150% declining balance must be used if the farmer is electing to use accelerated depreciation. And with a farm, the asset being depreciated can include livestock. A breeding pig is an asset that may have been purchased or raised. If the pig was purchased, the pig should be depreciated using Form 4562. Similar rules apply to tractors, barns, and other assets used on the farm for income production. So am I dealing with an asset or am I dealing with inventory? It is important to differentiate assets used for income production from other farming property, which is categorized as inventory held for sale or resale. And here's an illustration. For a farmer, a cow may be an asset used to produce milk, like this guy right here, or it may be a product that is raised to sell, such as feeder cattle that you see right here. A cow raised for sale is a form of inventory, and figuring the cost basis of a breeding pig is very similar to figuring the cost basis of a photocopier, tractor, or any other asset placed in service for use in a business activity. If you remember that farm animals used for breeding or as work animals are assets, and that farm animals raised for sale are inventory, you are well on your way to understanding how farming income works. But there are 10 issues or 10 key issues relating to the reporting of farm income that are problems frequently, per the IRS. If you have a farming business, there are several tax issues to consider before filing your federal return. The IRS has compiled a list of 10 things that farmers may want to know. Number 1, crop insurance proceeds. You must include in income any crop insurance proceeds you receive as a result of crop damage. You generally include them in the year that you receive them. Sales caused by weather-related condition. If you sell more livestock, including poultry, than you normally would in a year because of weather-related conditions, you may be able to postpone reporting the gain from selling the additional animals due to the weather until the next year. Farm income averaging. You may be able to average all or some of your current year's farm income by allocating it to the 3 prior years. This may lower your current year tax if your current year income from farming is high and your taxable income from 1 or more of the 3 prior years was low. The method does not change your prior year tax. It only uses the prior year information to determine your current year tax. Deductible farm expenses. The ordinary and necessary costs of operating a farm for profit are deductible business expenses. An ordinary expense is an expense that is common and accepted in the farming business. A necessary expense is one that is appropriate for the business. Employees and hired help. You can deduct reasonable wages paid for labor hired to perform your farming operations. This includes full-time and part-time workers. You must withhold Social Security, Medicare, and income taxes on your employees' wages. Items purchased for resale. You may be able to deduct in the year of the sale the cost of items purchased for resale, including livestock and freight charges for transporting livestock to the farm. Net operating losses. If your deductible expenses from operating your farm are more than your other income for the year, you may have a net operating loss. You can carry that loss over to other years and deduct it, or you may get a refund of part or all of the income tax you paid for past years, or you may be able to reduce your tax in future years. Repayment of loans. You cannot deduct the repayment of a loan if the loan proceeds are for personal expenses. However, if you use the proceeds of the loan for your farming business, you can deduct the interest that you pay on the loan. Fuel and road use. You may be eligible to claim a credit or refund of federal excise taxes on fuels used on a farm for farming purposes. And finally, Farmer's Tax Guide. More information about farm income and deductions is in Publication 225, Farmer's Tax Guide, which is available at this URL or by calling the IRS at the numbers shown below. And a little summary of what's inside Publication 225, Farmer's Tax Guide. Farmers benefit from many special credits and laws that may not be available to other businesses. Farmers are also subject to different rules for depreciation. The special laws affecting farmers are covered in IRS Publication 225, Farmer's Tax Guide. This session, as I've already said, is about reporting self-employment income and is not specific to farming. Since farming is a specialized form of self-employment income, we do recommend that you read Publication 225 to gain more thorough understanding of the specific rules that apply to farming income, particularly if you live in a rural area where farmers are commonly coming into your tax office. In reading Publication 225, you will note that most of the topics covered in the publication, such as depreciation, business use of home, sale of assets, like-kind exchanges, etc., are areas covered in this session or in other sessions of the basic tax course. What you should make note of in reading Publication 225 is which rules are unique to farmers. In particular, you should familiarize yourself with the following topics that are covered in 225 that are specific to farming income, and they include agricultural program payments on page 9 of Publication 225, elected farm income on page 18, income averaging on page 18, soil and water conservation expenses on page 27, the uniform capitalization rules on page 31, converted wetland and highly erodible cropland on page 53, and special estimated tax rules for qualified farmers on page 84. All right, so at this point I wanted to break and have you work on a classwork assignment. We're not quite done with the lecture, but I'd just like you to break and kind of work, not listening to the sound of my voice for a little bit. So let's flip to the back of the manual and take a look at the classwork assignment. The classwork assignment is shown on page 46 of the manual, and it involves preparation of a tax return for Snow White. The forms you need to prepare are 1040, Schedule C, Schedule SC, Office Use of Form 8829, Depreciation 4562, and Sale of a Business Asset 4797. Snow White's problem looks a little bit like what you're going to be getting for your open book final exam, so this is a really good exercise to help you get familiar with coordinating these various forms in preparation of a business tax return. Snow White runs a child daycare business from her home at 2121 Huntsman Place. She is licensed by the state. Snow White was widowed in 2009 and has not remarried. Her 2 children, Grumpy and Happy, lived with her all year. She paid $2,575 for family health care premiums. Snow White had the following income and expenses in 2010. Income from child care was $60,000. The expenses that she paid included food for children, $3,200, toys for the children of $1,200. She bought a video game machine for $150 on 10/15 of 10, and a refrigerator to store child care food, which was purchased on 11/15 of 2010 at a cost of $550. She also had household expenses, including rent of $8,000, utilities of $200, and maintenance of $300. Snow White's house is 1,800 square feet in size, and she allows the children to use all of the rooms in her home except her bedroom, which is 200 square feet in size. She cares for the children in her home 8 hours per day, 5 days per week, and she closes her daycare for 2 weeks each year so she can take a vacation. She had the following car expenses: gas of $1,100, interest of $1,200, and repairs of $500. Snow White paid $7,000 for a 2005 Dodge Caravan to use in her business on 11/15 of 2009. The 2005 Caravan was purchased to replace her older 2000 Plymouth Voyager. Snow White had been using that old Voyager for her business since 2007. She drove the car 15,000 miles during 2010, and 2,000 were business miles. On 1/15 of 2010, Snow White sold her 2000 Plymouth Voyager for $1,500. Snow White had accumulated the following mileage amounts during the years she owned that Voyager. So in 2007, she drove at 3,000 business miles and 8,000 personal miles. 2008 was 2,500 business miles, 7,500 personal, and 2009 she drove at 2,000 business miles and 7,000 personal miles. She claimed the standard mileage rate all 3 of those years, and originally when she purchased that Voyager back on 1/31 of 2007, she paid $4,000. Snow White will receive a $400 Making Work pay credit. Please prepare her federal tax return. So at this point, please push pause on video playback, prepare Snow White's tax return, and when you are finished, please resume video playback for a review of the classwork answer key for Snow White's tax return. So I have up in front of you now the answer key for Snow White's tax return, and we're looking at her Form 1040. And the first thing I'm going to point out is that her filing status is qualifying widow or widower, in her case widow with dependent child. She lost her husband in the earlier year, 2009, so she enters the year of death of her spouse on the space provided next to line 5, and she checks the box on line 5. She will claim an exemption for herself, and she will also claim 2 dependents, Grumpy and Happy. They both qualify for the child tax credit, so she enters 3 exemptions. From this point on, we have to fill out forms, and we have to fill out a number of forms to come up with the line amounts that you see on the income lines for her tax return. So let's go take a look at those forms, and we'll start with Schedule C. Here is Snow White's Schedule C. We've entered the principal, business, or profession as child daycare provider. We've entered the business code that we found in the instructions on pages C9, 10, and 11 of the Schedule C instructions. We've also entered the business name, which is Snow White Daycare, and the business address that she carries on her business activity at. She uses the cash method of accounting, and she did materially participate in her business. This is not a new business, so we do not check the box next to line H. We get to the income section, and Snow White's gross receipts from her business were $60,000, so we enter that on line 1. She has no other returns and allowances or cost of goods sold, so $60,000 carries down to line 7. Next, we enter her business expenses, and the first expense we run across is the car and truck expense. So let's see where that number came from. We can see here in the wording of the problem that we tell you that Snow White had car expenses with gas of $1,100, interest of $1,200, and repairs of $500, but we're actually going to claim the standard mileage allowance for her, and if we look at the mileage that she drove during the year, we can see that she drove the car 15,000 miles during 2010, and 2,000 of those miles were business miles. So we know without even doing much figuring at all that 2,000 times 50 cents a mile is going to give us a $1,000 deduction to enter on line 9. Now, we didn't give you any instructions in here to use the standard mileage allowance. However, if you were to look at the percentage business use of her vehicle, you will see that if you take $1,100 of gas and $500 of repairs, and then figure depreciation on the van and multiply that all out by the business use percentage, you may as well just take standard mileage, and that's what we've done here. Now on line 13, we claim a depreciation deduction of $700. So let's go see where that number comes from. Obviously, we have to do a 4562 for that. And here is Form 4562. The wording of the problem tells you that there were 2 assets that Snow White bought during the year. She has a video game machine that she bought on 10/15 of 10 for $150, and a refrigerator for $550 that she purchased on 11/15 of 2010. But she is claiming a Section 179 deduction on these assets. So we enter the refrigerator on line 6. We're claiming $550 of cost, an elected cost of $550. But we also have listed property that she is claiming a Section 179 deduction on, and that is the video game machine. So let's go to page 2 of Form 4562, and there on line 26 we've entered the video game machine. We've stated that it's 100% business use and a cost of $150, and she's electing a Section 179 deduction on the full cost of that asset. We've also listed the Dodge Caravan, how much she paid for that asset. It was $7,000. She is not claiming any depreciation deductions on it, but she is filling in the business use information down here. The total number of business miles is 2,000. Total other miles is 13,000, and the total of all miles driven for the year is 15. Was the vehicle available for personal use? Yes. Was the vehicle primarily used by a 5% owner? Yes. And is another vehicle available? Well, for about 2 weeks she did have 2 cars available, but for the majority of the year the answer is no, she had only 1 vehicle. So we carry over the $150 of Section 179 deduction on the listed property back over to page 1 and enter that amount on line 7. We total these up and we end up with a net depreciation deduction for the year for Snow White's tax return of $700, and we're going to carry that over and enter it on Schedule C on line 13. The next item in line is interest. Well, where did that number come from? Well, Snow White paid interest on her car loan, and that interest is deductible to the extent that she can show that the car was used for business. So we're going to take 2,000 business miles, divide that by 15,000 total miles, and multiply that difference by $1,200. So when we do that, we get 2,000 divided by 15,000 times 1,200. That gives us $159.9999. We round that up to $160, and we enter $160 of interest expense on line 16B. The next item in line is supplies, and we gave you 2 different supplies to look at for Snow White. One was food for children in the amount of $3,200, and the other is small toys for the children in the amount of $1,200. They're non-depreciable. They have a life of less than a year when you've got a whole bunch of kids playing with them. So we entered those as supply expenses, and those are combined to be $4,400 on line 22. We add up total expenses that Snow White had for the year as $6,260. And that gives her a tentative profit on line 29 of $53,740. Now it's time to prepare her office use of home form. And here is the office use of home form. We begin on line 1 by entering the amount of house space, or the amount of square footage of the house that the children get to use, and that's 1,600 square feet. We told you that the house is 1,800 square feet in size, and the children really have the run of the place except for the 200 square feet that is Snow White's bedroom. And this is literally what my tax clients tell me. They have a daycare in their home, and most commonly the kids have the run of the whole home. And sometimes I've even had clients tell me that, yeah, when the kids take nap, they use her bed. And it's like, okay. So in this case, I tried to make it realistic just based on what my own clients have told me over the years. So 1,800 square foot house, 1,600 is used for the child daycare. That gives us 88.89% of the house being used for business purposes. Now we look to the number of hours that the children are in the home, and I told you in the wording of the problem that the children are in the home 8 hours per day, 5 days per week, and they're in the home all year except 2 weeks that she's closed for a 2-week vacation. So that means 50 weeks of the year times 5 times 8. That gives us 2,000 to enter on line 4. We divide line 4 by 8,760, which is the number of hours in a year, and that gives us 0.2283. 22.83 multiplied by 88.89 gives us 20.29% business use. Then on line 8, we enter the net profit from Schedule C before we figure office use of home or business use of home. Then on line 18, we enter the rent she had for the year. Rent expense was $8,000, utilities were $300, and other repair expenses were $200. We total up her expenses to $8,500, and now we multiply $8,500 by the business use percentage on line 7. That gives us $1,725. $1,725 is subtracted from her profit of $53,740, and she is therefore able to claim her home office expenses because the office use of home is not throwing her into a loss. So that means the expenses are allowed in full. The expenses of $1,725 are going to carry over back to her Schedule C and are entered here on line 30. That gives her a net profit on line 31 of $52,015, and of course the next step is to figure her self-employment tax. We begin completing Schedule SC by entering the $52,015 profit on line 2, but we did tell you that Snow White paid for health insurance during the year. She paid for $2,575 of health insurance. So we're going to subtract $2,575 from her profit of $52.15 and enter the difference of $49,440 on line 3. We then multiply line 3 by 92.35%, and that gives us $45,658. Now we multiply $45,658 by 15.3%, and that gives us $6,986. That is Snow White's self-employment tax, and she will need to enter that on Form 1040 on line 56. She also will enter $3,493 as 1/2 of her self-employment tax deduction on Form 1040. Go back up to Form 1040 and look for those two numbers. Here is the 1/2 of self-employment tax deduction, and here is the self-employed health insurance deduction. Both those adjustments to income add up to $6,068, and she then has adjusted gross income of $46,837. But there is one more number on line 14 that I want to show you. And how did that number get calculated? Where did it come from? Well, remember I told you Snow White sold her minivan? Let's take a look at those computations. To figure the sale of the minivan, or to report the sale of the minivan, we need to complete Form 4797 for Snow White. And before we complete that form, I wanted to show you how we get the numbers that we're going to enter on the form. So we had business use on Snow White's minivan over the years as follows. 2007, 8, and 9, the business miles were 3,000, 2,500, and 2,000 respectively, for total business miles of 7,500. Her personal miles, those same 3 years, added up to 22,500, and the total miles for all 3 years was 30,000 miles. We're going to take the business miles of 7,500, divide those by the total miles of 30,000, and we get overall business use over time of 25%. Now we look at how much Snow White originally paid for that minivan when she bought it. And in the wording of the problem, I told you she paid $4,000 for that minivan. And we multiply that $4,000 purchase price by the business use percentage. That gives us $1,000 of business cost. The sales price is $1,500, but we're going to multiply that as well by the business use cost or business use percentage. So $1,500 multiplied by 25% is $375 of proceeds from the sale of the minivan. Now let's look at the prior depreciation that Snow White is treated as having claimed on that minivan. In 2007, she drove business miles of 3,000, and the depreciation per mile in 2007 was 19 cents. So that gave her $570 of depreciation that she claimed in 2007. For 2008, depreciation comes out to be $525, and for 2009, it's $420. So that leaves us with $1,515 of total depreciation she has claimed over time. So here's the figuring that we need to enter on Form 4797 in Part 3. Ultimately, we're going to fill out Part 3 because through depreciation, Snow White has actually sold her minivan at a gain. Her business cost is $1,000. Her prior depreciation claimed using the standard mileage rate is $1,515, and she sells for $375. Ultimately, what this means is that her basis has been reduced below zero. Her basis is now negative $515, but she sells for $375. So she does have a gain of those two amounts that's going to carry, and that's where we get this $870 from. Now, over the years, I've had a number of students, particularly CPAs, ask me, you can't have a negative basis. And when you read instructions in IRS publications, they say you can't have a negative basis. Well, for business use purposes, she does have a negative basis, but for total overall purposes, no, she doesn't have a negative basis. She had a $4,000 cost originally. Depreciation claimed is $1,515. So overall, she doesn't have a negative basis. And I have talked with IRS auditors on this particular subject, and IRS auditors do agree with my computations here. So I just wanted to point that out. Now let's go to the 4797, and we're going to complete page 2 of Form 4797. Right here, we entered the description of the asset being sold, which was the Plymouth Voyager. The date it was acquired was 1/31 of 2007, and it was sold on 1/15 of 2010. The gross sales price is $375. The cost basis is $1,000. The depreciation claimed was $1,515. That gives us an adjusted basis of negative $515. And a gain of $890, all of which is attributable to recapture of depreciation. $890 will carry up to line 14 of the Form 1040. And here we have $890. So I think we've pretty much covered page 1 of Form 1040. Snow White has adjusted gross income of $46,837. Page 2 of her tax form comes next. She's qualifying widow with dependent child, so her standard deduction is going to be the same as if she was still married at $11,400. She also has 2 dependents and 3 exemption deductions, totaling $10,950. That gives her taxable income of $24,487. The tax tables tell her she has $2,834 of tax. Her child tax credit is $2,000. So that leaves her with income tax for the year of only $834. But now we have to add in that big self-employment tax amount of $6,986. That pushes Snow White's tax bill up to $7,820. Snow White has a making work pay credit of $400. It's the only withholding she has or the tax payment she has for the year, so she owes a boatload, $7,420. And I have to tell you that when you are dealing with self-employed people, this self-employment tax really is a killer for them. You can see that Snow White, if she worked for an employer, had a regular job, and her net income for the year was $50,000, she'd only owe $834 of tax when she files her return. A pretty small number. And throughout the year, her employer would have been holding out half of her Social Security and Medicare taxes and making a matching payment on her behalf. But when she's self-employed, there's no one doing that for her through payroll deduction. She just gets to the end of the year and whammo, it's all there as one big number that she owes all at one time. And this is why self-employed people are supposed to pay estimated taxes throughout the year. And there's a good number of self-employed people who understand this and are very diligent getting those estimated quarterly payments out. But it's just as common for me to see self-employed people make no effort to pay estimated taxes at all during the year. They get to this big number at the end and woof, it hits them hard. So that concludes the review of the Session 18 classwork answer key. Let's finish up our session now with a review of some of the very important tax advice you as a tax preparer should be giving your tax clients when it comes to record keeping. So today I'm going to finish off Session 18 with a discussion of record keeping and financial management advice for clients. As a tax preparer, it is impossible for you to prepare an accurate tax return if your clients don't give you accurate information. And if they're self-employed, the odds of that information being inaccurate are very high. As a tax preparer, I work off the assumption that my client's information is bad. I need them to prove to me it's right before I go with it. Or, if they bring me a P&L and they say, it's perfect, you don't need to worry about it, then I make a note of the fact that they didn't ask me to review it and that all of the numbers on it are unverified by me. I'm simply trusting that they know what they're doing and I'm putting it on. But 100% guarantee if they get an audit, they're going to have problems because they didn't let me review the work. And that's how I feel about being a tax preparer, that it's my job to prepare a tax return that will hold up in an audit, and it's not going to hold up in an audit if I didn't analyze the profit and loss and the entries that went into creating it. So when my clients come in to see me, I want to see a breakdown of the numbers of each line that appears in that P&L so that I know that the backup behind those numbers is valid, allowable deductions. And better yet, if they have a QuickBooks disk, I want them to do a backup of their QuickBooks for me so that I can go in and delve into their QuickBooks and see what they've done right and what they've done wrong. And when I get into QuickBooks, oh my gosh, sometimes I see messes beyond belief. And it doesn't matter whether they do it themselves or whether they use a professional bookkeeper. It's a mess in most cases. Even when I have a client who's really, really, really diligent and has us monitor their QuickBooks accounts on a regular basis, I'm still going to find stuff because most small business owners are not professional tax preparers or bookkeepers. They're busy making their earnings or making their living doing what it is they do, and the bookkeeping is just one of those tedious tasks they have to do on the side, and they usually either leave it all till they're trying to do it at one time, or they're doing it as they go, but they're not really sure of what they're doing, and so any way you call it, it's always usually a mess. So my job at the very beginning is to see if my client can even deliver to me a P&L that I think is worth turning into a tax return. So I'll go through the P&L and I'll look for problems. If I see problems, I tell my client how to correct them. Or I may just adjust for those as I'm preparing the return. For example, if I see that my client, and this is very normal, paid a personal expense and that personal expense is showing up in his P&L as an expense, then I may back that out. But as often as I see one incidence of an unallowed expense being on a P&L, there's probably 100 unallowed or unallowable deductions or expenses being included on that P&L. So very often it's a big job to pull everything out. But I do that because I care about the quality of the work that I'm doing for my tax clients. So here's some of the advice I'm going to give you today. After that preamble, let's get into what it is I'm trying to communicate. Tax return preparers have an ethical duty to prepare tax returns that accurately reflect income and deduction items reported on the tax returns they prepare. When you are working with a tax client, the following information and advice should be communicated to your client to ensure that your client is able to support income and deduction items claimed on his or her return in the event that the return is audited by the IRS. Record keeping. You are required to keep records which prove your business income and expenses. Adequate record keeping can be accomplished in the following ways. Number one, if you are claiming business expenses, you need to keep your receipts. And it is wise to charge your gas and other business expenses to a different credit card than the one that you use for your personal expenses. That way it is easier to track and separate business expenses from personal expenses. Now, this is a true dream, having my clients use one credit card only for business and one credit card only for personal. It's an unfulfilled dream, but it's an objective. It's something that you should explain to your clients that they should do. And the reason for that is, well, it keeps things clear, concise, and frankly, it saves them money. If they have to pay a bookkeeper or a tax preparer to sort out all of those combined expenses that are muddled up on a single bank account or a single credit card statement, that's a ton of work. compare that to, oh, every time I make a business purchase, I use my business card, and every time I make a personal purchase, I use my personal card. Then when it comes tax time, I only have to give my accountant or my tax preparer the business card, and there's no personal expenses on there to pull out. Well, what a dream. I wish. Also, you should keep an envelope in your car where you can store receipts as you acquire them. As soon as possible, file your receipts in an organized manner, because remember, lost receipts equal lost deductions. You should maintain your business records for a minimum of 3 years from the date that you file your return. Lots of business owners throw the receipts out after 3 or 4 days, or they put them in a box where they sit for a few months and then they throw them out. Well, I'm sorry, but if the auditor comes knocking, the auditor's going to come knocking about 2 years after you made that purchase, not 2 weeks or 2 months. A canceled check is not considered to be adequate evidence of an expense by itself, and it should be accompanied by a receipt or other form of documentation. So how much money am I really making? That would be a reason to keep good records. Whether you prepare your own tax return or you use a paid tax professional, you need to keep good records. And you need records to prepare and file tax returns, to complete loan applications to purchase important items like, well, cars and houses, plan for your retirement, and make important career management decisions like, is this a good place for me to be making my living? Maybe I shouldn't be self-employed because I'm not making any money. Maybe I should go, get a job where someone pays me and I'll make more for less stress. Or maybe, wow, I didn't know I was making that much. So that being self-employed is a good choice for you career-wise. Also, you want to keep good records so that you can manage your money and live a financially secure life. Most people worry about money a lot. And it's even more of a worry if you don't even know how much you're making or how much you have or where it went. Those are important things. And the final reason to keep good records is, well, to save money on your taxes. If you don't keep good records, odds are you're paying too much tax because you've lost all of the information that your preparer would use to figure your deductions. Minimum standards for record keeping. Separation of business and personal is a crucially important first step. You can accomplish this by following these simple rules. Never pay cash for anything, if you can possibly help it. Keep a separate bank account for your business, and do not mix income and expenses of your business with personal income and expenses. Keep a separate credit card for your business, and do not use your business card for personal or your personal card for business. Get the idea? Now, if all of my money is in my business account, what am I going to live on? This is the question my clients ask me all the time. Well, that's very easy. You pay yourself by writing a check to yourself from your business account. And in the memo section of your check, write owner draw. You can then deposit the check from your business account into your personal account and spend the money from your personal account as you need to. Another question I frequently get, what if I need to put money into my business account? What if there's not enough in it and I need to put money in it? Well, that's easy too. You write a check to your personal account from your owner personal account, and on it you write owner contribution in the memo section of the check. Now, what if I have to pay cash for something? Because that does happen, where you're in a place that doesn't accept credit cards and they don't accept checks, so the only thing left is cash. Well, what do? Well, I guess you pay cash. But if you pay cash, you should keep an envelope in your car labeled cash receipts. And as soon as you make a cash purchase, put the receipt in the envelope. That way you don't lose it. So let's look at the ultimate in record keeping. In my perfect dream world, this is how every client would come to me. Ideally, you should sort your expenses first by category and then by the date paid. You should keep a file cabinet and use folders to keep your records and receipts sorted and organized. You can sort by vendor and/or category, but sorting by months paid is not an efficient way to organize records for most businesses. Now, I repeatedly, all the time, have clients who like to organize their records by the months they had an expense. So they'll bring me, 12 envelopes, one for each month with all the receipts in there. Well, you just saw the Schedule C. It isn't organized by month, is it? It's organized by category. So it's a whole lot more helpful if my clients organize their expenses by category. Month paid is, relevant if you want to make sure you're only including expenses that were paid in the year, which is, of course, a requirement. But beyond that, we really need to know what the categories are. So if your client brings you an envelope full of receipts, Organized by months, well, you're going to have to go through and sort it all out, or you're going to have to send your client home and ask them to do that for you. So when you do sort, you can sort by vendor and category, and month is a bad idea. But examples of categories you should use include office supplies. And what would you put in that category? Well, things like pens, paper, ink cartridges, coffee, etc. Marketing supplies, printing and production costs of flyers, business cards, promotional calendars, etc. Advertising, that includes things like newspaper ads, direct mail, real estate management listings, lawn signs, etc. Utilities, sort by vendor as follows: gas, electric, water, trash, internet. Cell phone is another category in and of itself. Auto, if you use actual expenses instead of the standard rate, you should keep receipts for all of the following auto expenses, including gas, oil changes and maintenance, repairs, and insurance. Even if you claim the standard mileage rate, you should still keep up the following auto records, including car loan interest, lease payments, and purchase and sale of the automobile itself. Now, if you're claiming standard mileage rate, you may say to yourself, well, why do I need to keep track of all of these other costs? Well, the oil change one in maintenance is rather important, and the reason I say that is I've observed auditors, and auditors like to see some other sort of verification of the number of miles you've put on a car. And you can keep a mileage log of the places that you went, but at the end of the year you have a total amount of mileage that you put in that car. And if you go to get your oil changed, and every time you get your oil changed, there's a record made of the number of miles on your car at that point, then that is kind of a third-party verification that you actually did put miles on your car at all. So you could tell the IRS on your tax return and through a mileage log that you put 15,000 miles on your car during a year, and that 10,000 of those were business miles. But if you go to Jiffy Lube and you get your oil changed, and Jiffy Lube for a one-year period shows you only put 10,000 miles in your car, well, an auditor is going to notice, well, how could you drive 10,000 business and 15,000 total when in that same one-year period, Jiffy Lube records show you only put 10,000 miles on the car? So auditors are savvy to stuff like that, and they will ask to see those oil change records. Entertainment expenses. The types of records you should keep for entertainment expenses include things like receipts for local meals where substantial business purpose exists behind that meals, a party you may have held for your clients, sporting events where business activities occur prior, during, or after the event. For example, you take a client golfing or to a professional golf sporting event. In the category of travel expenses, you would include meals while away from home overnight, hotels, airfare, car rental, and taxi, but remember that the meals have to be specifically separated out because they are going to have a 50% limit applied to them in most cases. Business insurance, including errors and omissions, and rider insurances. Business credit card, the amount you pay for credit card fees and interest, and business line of credit. Legal and accounting expenses, including tax preparation, bookkeeping, legal expenses. Professional fees, including desk fees, professional membership dues, etc. Office supplies, or office expense, including desk fees paid to a broker and pens and paper and so forth. Repairs, including repairs to office equipment. Taxes and licenses. You should keep a record of estimated tax payments, business license payments, real estate license expenses, etc. Gifts, not charity. Gifts to clients or business relations. So charitable contributions belong on Schedule A, and they are not claimed as a gift expense on Schedule C. Client expenses, including home warranties and other expenses you might pay for your clients. Assets that you might have purchased, such as computers, cell phones, furniture, printers, etc. Bank and credit card statements, and miscellaneous. Well, I already talked about this at the start of today's class. The IRS does not recognize the category of miscellaneous expenses. If you don't know how to categorize an expense, call it by name and give it its own file. So let's talk about bookkeeping next. Many of my clients say, would it help if I bought QuickBooks or Quicken? And my answer for many of them is, please save yourself some money, because unless you are running a fair-sized business and can afford the services of a professional bookkeeper, you are better off taking your records to someone else. The money you save on software could be used to pay someone who knows how to prepare an accurate P&L for you. If you do decide to purchase bookkeeping software, purchase QuickBooks, and then pay an experienced and qualified bookkeeper to set your company up in QuickBooks properly. Accurate bookkeeping requires application of acceptable accounting methods and knowledge of the deductibility of business expenses. Most business owners lack the knowledge, skills, and time to set up or maintain a sophisticated accounting system without the help of trained professionals, and therefore should be prepared to pay for a knowledgeable accounting professional to assist them with setting up and maintaining an accounting system. At the same time, many individuals hold themselves out as competent bookkeepers when they are not competent at all. Oh my gosh, I've seen some bad bookkeepers. Bookkeeping is not a regulated profession, unfortunately. Therefore, it is common for an individual to purchase a software program like QuickBooks and then start up a business offering QuickBooks services, even though that individual has no formal training in QuickBooks or accounting. Business owners should be careful to select a bookkeeper who holds an accounting degree or some other certificate of completion from a licensed bookkeeping school. Tax preparers should assume that any profit and loss provided by a client has bookkeeping errors in it and should analyze profit and loss reports or QuickBooks files for errors prior to preparing a client's business tax return. So here are some good bookkeeping suggestions. Your client should use a competent bookkeeping service. That's the best option if they can afford to pay it. Now, as a small business, you could deliver your records to a bookkeeper and expect to pay anywhere from $40 to $50 an hour. It could be lower than that. It could be higher than that, just depending on the cost of living in the area that you are working with your bookkeeper. You could also have a bookkeeper come to your business. And generally in our area, we see fees of around $60 to $70 an hour for that type of service, but you may find you're considerably more or less depending on the region of the country you are in. Also, you can hire a trained accountant to work on staff as an employee of your business. Businesses who can afford to employ a full or part-time accountant on staff should do so. Annual salaries start at $30,000 or more, depending on the level of education and experience an individual has and the region of the country you are in. Another method outside of using a bookkeeping service is just to use Excel or another similar type of spreadsheet program. This can be perfectly good. And what you do is for each file in your file cabinet, you create a column in the Excel spreadsheets. You have a column for supplies, you have a column for gas, you have a column for rent, right? And each month when you go through, you just start listing the amounts that you paid in each of those columns. And at the end of the year, you just total them at the bottom, boom, you've got basically a P&L. It doesn't look like one, but it does the same thing. It's totaled up all of your expenses. It's based on hard numbers that you entered in from actual receipts or canceled checks. And finally, you can list each item on a separate piece of paper and just run a tape to total the receipts at the end of the year. That's actually perfectly adequate as well. And for my small business clients, that's probably all they need to do. Essentially, they keep manila folders with all of their receipts in them. At the end of the year, they open up the manila folder, they take an adding machine, they add up all of the receipts in there, and they staple the total from the adding machine tape to the front of the file, and then they bring the files into me, or they write on a sheet of paper what the total of all of those files was, and they're good to go. And that is perfectly adequate. All of the receipts and all of the totals are in one place. If that client gets audited, they can go to the audit with those files, and they're running tape totals on the front of each. They can see, the auditor can see that the number totaled on that file is the number entered on the tax return. They can see all the backup verification. That audit should go smooth as silk. Okay, so that concludes the Sessions 18 lecture, and the final password of the day I'm going to give you is Colorado, C-O-L-O-R-A-D-O. And here is your homework assignment for today's class. It involves preparation of a tax return for Jacob Grimm. He needs to file a 1040, Schedule C, a Schedule SE, a Form 4562, an 8829, and a depreciation schedule. Jacob runs a pest control business from his home in Bismarck, North Dakota, and he is licensed by the state. He paid $2,760 for his health care premiums. He had the following expenses and income for the year. Here's his income. Here are his expenses. He also traveled to Devil's Lake, North Dakota on October 12th to take care of a job at a resort there. He spent 4 full days working at the resort, $380 for lodging, $240 on food. His miles for that trip are already included in the business mileage figures that I have below. During the year, Jacob hired several independent contractors to help him with his jobs, and the total he paid these individuals is $5,465. He gave them a 1099 miscellaneous whenever it was required. Jacob had one customer who was not pleased with the work performed, so he had to refund that customer $250. Jacob's house is 1,400 square feet in size, and he has a bedroom that he uses exclusively for his business, which is 200 square feet in size. These are the expenses for office use of home. And during the year, he drove his truck 13,400 miles, 9,380 were business miles, and he has taken actual expenses in the earlier years. Here is the amount he paid for his auto expenses. Jacob placed the following assets in service during the year. We have 2010 S10 Chevy, a truck canopy, and pest control spray equipment. He lost last year's tax return and has absolutely no idea how much depreciation he has taken on his assets, so he's going to need you to figure it out for him. He does know that he used his truck 70% business use every year since he placed it in service, and he has not taken a Section 179 deduction on any asset placed in service, but he has taken bonus depreciation in any earlier year where it was allowed. So your job is to go back in time and figure out how much depreciation he has already claimed, figure his adjusted basis in his property, and then figure the 2010 depreciation on these three assets. So that's going to be a big job for you, but have at it. Jacob also made the following estimated tax payments to IRS during the year, and he will receive a $400 making work pay credit. You can see that this is a pretty complex homework assignment, but it's really the last tax return that we're going to have you prepare before you're going to be off and running with the final exam for this course. So really do put some concerted effort into pulling everything you've learned during this course together in the preparation of that tax return. At the beginning of our next class, I will, of course, review the answer key to this assignment. And the very next class we have is actually going to be on IRS ethics, and it is the final federal session of this course. So once you finish with the ethics session, you're going to need to prepare the final take-home exam for the basic tax course, and that final exam does involve preparation of what I consider to be a complex tax return, and it's really going to help pull together everything that you've learned during the entire 19-session course. So thank you for participating in today's class. I will see you back again at the beginning of our final federal session, Session 19. Bye-bye.